SQE prep. Preparing for the SQE is like climbing a mountain.
But you don't have to climb alone. This video explains everything you need to know. Let's do FLK.
Why did the newly qualified solicitor bring a suitcase, a calculator and a shredder to their first day at work? Because they'd been told their job was to handle starting businesses, managing decisions, balancing stakeholder interests, finding finance, sorting the tax man, and then winding everything up. Basically, birth, life and death of a company. Or in any event, this is what the SRA specification requires for FLK business law and practice. This video, prepared by Dr. Yannis, takes you through 7 key items in this part of the FLK. This isn't a how-to for entrepreneurs, it is a roadmap for passing the SQE1 with confidence by understanding what the examiner expects a competent, newly qualified solicitor to do when faced with realistic, client-based and ethical problems. We will travel through the syllabus and its 7 key areas. First, by identifying the business vehicle and its consequences. Second, understanding who makes decisions and how. Third, structuring and securing finance. Fourth, mapping the rights and obligations of stakeholders. Fifth, calculating and explaining the principal tax consequences. Sixth, closing with termination in both solvent and insolvent scenarios. Seventh, professional conduct and regulation. Along the way, we will weave in professional conduct, money laundering risk, documentary practice, accounts literacy, and the practical hallmarks of good MCQ practice. Think of this as a spoken study guide, dense, applied, and relentlessly focused on passing SQE1.
1. Identifying the business vehicle and its consequences. Every business law discussion begins by anchoring the vehicle. Think of a fact pattern that speaks of 2 designers sharing profits points to an ordinary partnership unless they form something else. A professional firm with limited liability and filings at Companies House points to an LLP. A registered number, directors and shares point to a company. This is not trivia. Vehicle determines liability, tax treatment, public filing, decision-making and how you fix problems. A sole trader is simply the individual trading. Capacity, ownership and liability sit with the person. A general partnership arises where persons carry on business in common with a view to profit. It has no separate legal identity for most purposes. Each partner is an agent of the firm, and liability is joint and several. Always consider whether partners have actual or apparent authority to bind the firm, and whether any restriction in an internal agreement affects third parties. An LLP is a body corporate with separate personality. Members enjoy limited liability, yet are usually taxed on their profit shares. It requires at least 2 designated members to shoulder filing and compliance. A limited company is also a body corporate. Shareholders risk only what they have paid or agreed to pay for their shares, and decision-making is split between the board and the members. A private company cannot offer shares to the public and enjoys flexible written resolutions. A public company carries stricter capital rules and can raise money from the public once properly certified. In a scenario involving fundraising from the crowd, red flags about a private company offering shares widely may appear. Note the prohibition and the need for exemptions. Formation problems are common and high yield. When you see pre-incorporation contracts, remember that a company cannot contract before it exists. If someone signs for and on behalf of a non-existent company, they are generally personally liable, unless the arrangement is properly novated after incorporation. Score easy marks by explaining how to tidy this up. Incorporate first, redocument post-incorporation, and record reimbursement of promoter expenses properly. When a question turns on corporate capacity and constitutional constraints, remind yourself that the company's powers flow from its articles. Modern articles grant wide capacity, but directors still must act for proper purposes and within authority. If a fact pattern hints at a company name that suggests government affiliation or a registered office that is a PO box, mention the sensitive name regime and the need for an appropriate address that will bring official post to someone acting for the company. Increasingly, identity verification and register accuracy are part of the compliance landscape. In practice, treat them as baseline hygiene, and in an exam, explain that accurate filings and confirmation statements are not optional extras, but part of the company's bargain with the state.
2. Understanding who makes decisions and how. Once the vehicle exists, shift to who decides and how. The board manages the business. Directors must be at least 16 and owe their duties to the company. These duties are your anchor whenever you see a governance or ethics problem. Acting within powers means reading the articles and any shareholders' agreement to see what requires member approval. Promoting the success of the company for the benefit of its members requires you to take a long-term view and to consider employees, suppliers and customers, community and environment, reputation and fairness between members. In an exam, apply that list rather than recite it. Independent judgment forbids rubber stamping a dominant shareholder's wishes. Reasonable care, skill and diligence blends an objective baseline with the director's actual skill. A finance-savvy director is judged more strictly. Avoiding conflicts means you cannot place yourself in a position where duties to the company pull against personal interests, and not accepting benefits is about declining inducements offered because you are a director. Disclose interests in proposed transactions promptly and minutely. Many conflicts can be authorized by independent directors or the members under the articles, but only if the right people make the decision the right way. If the scenario features a director signing for both sides of a deal or buying an asset from the company, you should hear alarm bells. Declare the conflict, consider member approval for substantial property transactions with directors, and check any relevant statutory restrictions on loans and guarantees to directors. Member decision-making is an exam perennial. Ordinary resolutions pass by simple majority and deal with routine matters. Special resolutions require a higher threshold and underpin constitutional changes, name changes, and capital reductions. Written resolutions are available to private companies, but not for removing a director or an auditor. If removal is on the table, note the special notice requirement and the need for a meeting. Where the articles contain weighted voting protecting a director from removal, recognise how that interacts with the statutory regime and what investors might have negotiated to counterbalance it. Always watch for class rights. If preferred shareholders lose a dividend priority by amendment, that is a variation of class rights requiring the consent procedure in the articles or statute. An attempt to do it by simple ordinary resolution for all members is a red flag. In small quasi-partnership companies, minority remedies carry real weight. If a majority freezes out a founder by excluding them from management, diverting business, or manipulating remuneration, unfair prejudice becomes the tool of choice. The remedy in practice and in the exam is often an order that the petitioner's shares be bought at a fair value without a minority discount. Mention derivative claims when the company has suffered a wrong, but the wrongdoers control it. Explain that the court's permission stage filters weak or tactical litigation.
3. Structuring and securing finance. Finance comes next, and here you must separate equity and debt cleanly. Equity is permanent capital raised by issuing shares. Private companies need authority to allot shares. They must respect pre-emption rights on new issues for cash unless those rights are disapplied. Failing to offer new shares to existing shareholders pro rata is a frequent breach. Consider class rights when issuing a new class, with preferential dividends or enhanced votes. Ask about consideration. Shares may be issued for cash or non-cash assets. In public companies, non-cash consideration demands a valuation ritual. Keep an eye on share premium and on whether the company has distributable reserves to fund later buybacks or redemptions. Debt preserves ownership but brings covenants and almost always security. Debentures evidence the loan relationship and usually grant fixed and floating charges. The difference between fixed and floating charges is central to priority in solvency and therefore central to marks. A fixed charge attaches to a specific asset and severely restricts the company's freedom to deal with it. A floating charge hovers over a shifting class like stock or receivables and allows trading until crystallization. Priority follows logic. Fixed beats floating and broadly earlier registrations speed later ones. Registration of most charges at Companies House within the short statutory window is essential. Missit and the security may be void against an administrator or liquidator. Expect questions about negative pledge clauses after acquired property and the practical need for intercreditor agreements where two lenders share a collateral pool. In receivables finance, be ready to explain how outright assignment differs from a charge, how notice the debtors affects legal versus equitable assignment, and how bans on assignment are treated. Where the fact pattern hints at a large customer contract that forbids assignment, explain how modern law limits the effectiveness of these bans in most business-to-business context, while noting sectoral exceptions. Distributions are a favourite trap. A dividend may be paid only out of distributable profits shown in the relevant accounts.
It is not a matter of cash in bank, it is a question of realised profits after realised losses. Dividends paid unlawfully can be clawed back from shareholders who knew or ought reasonably to have known and can expose directors to claims. If the balance sheet is choked with paid-up capital and share premium that blocks distributions, a capital reduction can reset the accounts. In a private company, this can be done by special resolution supported by a solvency statement. In a public company, court approval remains the norm. Buybacks are heavily procedural. An off-market buyback requires a special resolution approving the contract in its exact form. The consideration must come from distributable profits or a fresh issue, and timing, filings and cancellation formalities must be flawless. If your scenario features a public company assisting a purchase of its own shares, recall the narrower but still real prohibition on financial assistance that remains for public companies and their subsidiaries. Testing whether a proposed loan or guarantee falls within that prohibition and what whitewash or structuring is available can bring easy credit if you apply the rule to the facts and explain the risk of void transactions or directed liability if the rule is ignored.
4. Mapping the rights and obligations of stakeholders. Stakeholder rights and obligations are the meat in many questions. Directors' duties we have covered, but add to your toolkit loans to directors, quasi-loans and credit transactions that require member approval, and substantial property transactions with directors or connected persons which also need approval. Breaches can be ratified in some cases by disinterested shareholders, but this is not a get-out-of-jail card. Explain the limits and the optics. Members' rights include dividends, information, the right to attend and vote, preemption rights on new issues for cash unless disapplied, and where shares are transferable, a right to transfer subject to any restrictions in the articles or shareholder agreement. When shares change hands, remember stamp duty or stamp duty reserve tax and the need for correct stamping or electronic settlement for registration. Employees appear in governance and insolvency in two guises: as a stakeholders whose interests directors must have regard to, and as a preferential creditors for certain claims if insolvency arrives. Lenders are stakeholders with teeth. Their rights depend on the contract and the security. If there is a negative pledge, a later lender's attempt to take fixed security may breach it. If there is a springing covenant tied to leverage, a subtle shift in EBITDA, an acronym for earnings before interest, taxes, depreciation and amortization, may move a covenant from approaching to breached. Always read the numbers the scenario gives you. They are seldom ornamental. Business accounts are examinable, not because you must be an accountant, but because you must read and explain what the numbers say. The three statements each have a job. The statement of financial position shows assets, liabilities, and equity at a date. The statement of profit or loss shows income and expense over a period. The cash flow statement explains cash movements. A profitable company can run out of cash if receivables stretch and inventory swells. If a question asks whether a dividend is lawful, point to distributable reserves per the last accounts, adjusted for post-balance sheet events if management accounts are used. If you are asked whether a solvency statement is appropriate for a capital reduction, read the balance sheet and cash flow together. Can the company pay its debts as they fall due for the next year, and is there no threat of insolvency? Learn the click paths. Gross margin is revenue minus cost of sales over revenue. Current ratio and quick ratio say something about liquidity. Net assets support capital maintenance tests. Do not guess numbers, lift them from the scenario and think what they mean.
5. Calculating and explaining the principal tax consequences. Taxation sits across the syllabus, but the examiner wants confident navigation more than rate memorization. For companies, identify trading profits, property income, and chargeable gains, adjust for allowable deductions, and note the rate structure. When the company pays dividends, explain that they are paid from post-tax profits and taxed again on the shareholder at dividend rates with a separate allowance. In an exam, apply the rates and allowances supplied. For individuals, separate employment income taxed under PAYE from trading income under self-assessment. If you see a disposal of business assets by an individual, test eligibility for the 10% rate under business asset disposal relief up to the lifetime limit, and check conditions such as shareholding percentage, officer or employee status, and trading requirement for a personal company for the relevant qualifying period. Value-added tax questions pivot on 3 steps. Decide whether there is a supply of goods or services for consideration in the course of business. Determine the place of supply and whether it is standard-rated, reduced, zero-rated or exempt. And test registration thresholds and the timing of registration. Add invoicing and record-keeping obligations, the right to deduct input tax where supplies are taxable, and common pitfalls such as exempt mixed businesses with partial exemption calculations. If a scenario includes a share, sale, sale versus an asset sale, contrast the corporation tax, VAT, and stamp duty outcomes. A share sale is typically outside the scope of VAT and triggers stamp duty on shares. An asset sale may be within scope unless treated as a transfer of a going concern and may crystallize gains inside the company. When fundraising, note stamp duty reserve tax on paperless share transfers and any disapplication of preemption rights. When granting loans, consider the tax treatment of interest receipts and any withholding obligations if the lender is overseas. Thresholds and rates move. Signal awareness by stating that you will apply the rates provided with the question and focus your analysis on classification, computation steps, and planning choices.
6. Termination in both solvent and insolvent scenarios. Turning to termination, always begin by distinguishing solvent from insolvent processes. A member's voluntary liquidation is for solvent companies. Directors swear a statutory declaration of solvency, and a liquidator realizes assets and pays creditors in full before distributing surplus to members, often yielding neat tax outcomes. A creditor's voluntary liquidation or compulsory winding up deals with insolvent companies. But insolvency is not a single road. Modern rescue tools matter. A standalone moratorium buys breathing space, with a monitor supervising whether rescue is possible. Administration can rescue the company as a going concern, secure a better result for creditors than liquidation, or realize property to pay secured or preferential creditors. A company voluntary arrangement compromises unsecured debts with creditor approval while management stays in place. A restructuring plan permits court-sanctioned compromises with the possibility of cross-class cram-down where the statutory tests are met, allowing a viable plan to proceed despite a holdout class. These labels must be tied to facts. If a company is balance sheet solvent but facing a tight covenant default, a short moratorium might give the time to sell a division. If there is a swarm of small trade creditors but a supportive senior lender, a CVA might clean the tail. If the capital structure is misshapen, with junior debt blocking change, a restructuring plan with cram-down may be the surgical tool. In liquidation, distributions follow a strict order. Costs of the process, fixed charge holders from their collateral, preferential creditors, the ring-fenced prescribed part for unsecured creditors out of floating charge realizations, floating charge holders from the remainder, and finally unsecured creditors pari passu with shareholders last. Directors who traded on when they should not have may face wrongful trading claims. If dishonesty is present, fraudulent trading and disqualification follow. Antecedent transactions are clawed back. Gifts or deep discounts, preferences, extortionate credit, and certain late floating charges. If you see a director repaid a loan days before a petition or a machine sold to a cousin for a song, analyze which avoidance tool fits, identify the relevant look-back period, and describe the remedy. Partnerships and LLPs deserve their own focus because many questions lift facts from professional firms. In an ordinary partnership, authority and liability are broad. If a partner orders stock in the usual way of business, the firm is bound even if that partner breached an internal limit. Dissolution can occur by agreement, by expiry, by notice, or by the court on just and equitable grounds. On dissolution, partners settle between themselves according to the default rules or any agreement, but remember third-party creditors first. An LLP changes the risk calculus. Members are generally not liable for the LLP's debts simply by being members. Designated members carry compliance burdens. Internal arrangements are contractual. Expulsion requires an express power, and remuneration and profit shares are a matter of agreement. In distress, wrongful trading liability has an LLP analogue. Members who withdraw capital in the twilight period may face contribution claims. A question involving an insolvent LLP with disappearing drawings is an invitation to address these rules.
Professional conduct and regulation run through every business law question because you are training to be a solicitor, not just a technician. Begin with client care. Identify the client, set scope, explain costs, and confirm how you will communicate and on what timescale. Conflicts of interest are common in transactional work. Acting for both a company and its directors on a share sale may be fine if their interests align and you can manage any divergence. Acting for both buyer and seller is rarely acceptable unless the strict criteria for a permitted exception are met, and even then, vigilance is required. Confidentiality is fundamental. If you acquire confidential information from one client that would be material to another matter, you must not misuse it. Information barriers in small firms are often unrealistic. Undertakings are personal and sacrosanct. Give them sparingly, fulfill them promptly, and never give an undertaking you cannot perform. Money laundering obligations bite early. Know your client, identify beneficial owners, understand source of funds, and in higher risk cases, source of wealth. Politically exposed persons are not forbidden clients, but require enhanced due diligence and senior approval. If you suspect criminal property, tipping off is a crime. Follow reporting lines and pause the relevant step until you have consent. Sanctions screening is now mainstream. Do not pay or receive funds until screening is clear. The SRA accounts rules demand disciplined handling of client money. Pay client money into the client account promptly, transfer earned fees to the office account only when billed or agreed, perform three-way reconciliations, and return residual balances without delay. If a fact pattern includes rounded-up transfers, delayed banking, or paying one client from another's funds, call it what it is, a breach that must be remedied and reported if material.
Skills. Knowing things is step one. Learning now to apply that knowledge is where the game is played. Email subscribe to newsletter at gelingtus.co.uk so Dr. Yannis can send you MCQs to try at home for free. But let's do some practice together right now. Documentary practice earns quiet but important marks. If you're asked to allot shares, think through authority to allot, preemption, board minutes, members' resolutions, forms and filings. For transfers, look for the stock transfer form, the payment or exemption of stamp duty, or SDRT, board approval under any transfer restrictions, and updating the register of members, then issuing a new share certificate within the time limit. For charges, think of the security document, board authority, members' approval if needed, registration at Companies House within the deadline, and updating the company's own register of charges. For buybacks, recall the need for the contract to be approved in the exact form, payment conditions, cancellation of shares, and filings. For capital reductions, identify whether you are using the solvency statement route or the court route in a public company, recall the director's considerations, and make the Companies House filings on time. A candidate who understands documents and filings sounds like someone who can actually do the job. Examiners reward that. MCQ craft is as important as knowledge. Read the facts and organize them against the syllabus headings the assessor is trained to look for. Vehicle and capacity, decision-making and authority, stakeholder rights and remedies, finance mechanics in priority, tax classification and consequences, and termination options and risks. Identify the legal rules shortly and then match it to the facts. If the question gives you dates, use them to test limitation periods, look-back windows for antecedent transactions, and filing deadlines. If it gives you financials, use them to decide if a dividend is lawful, whether a solvency statement is plausible, or whether a covenant is breached. When ethics appear, a day one solicitor is supposed to understand the need to signpost them clearly and propose a safe course of action. Pause, seek instructions, disclose a conflict, refuse to act, report internally, or file a suspicious activity report as appropriate. Avoid conclusory phrases like clearly and obviously. This is law, not opinion. Prioritize issues by impact. Questions can involve where money moves or decisions are made unlawfully. Unlawful distributions, misapplied preemption, defective buybacks, invalid meetings, unregistered charges, unapproved loans to directors, or transactions at an undervalue before insolvency.
Let's build several archetypal scenarios together for revision. Imagine a private company with two founder directors and an angel investor. They want to issue new ordinary shares to the investor at a premium, accelerated dividend to sweeten the deal, and grant the investor a board seat with a veto on issuing further shares. Your first step is authority. Do the directors have power to allot under an existing resolution, or must members authorize a new allotment? Next, preemption. Are rights disapplied to permit a non-preemptive issue to the investor? And if not, what procedure and resolution are needed? Then class and rights. Are these shares truly ordinary, or do they have rights that create a new class requiring special procedures? Now the dividend. Are there distributable reserves today? And are you using the right accounts? If profits are thin, flag the risk of an unlawful distribution and suggest an interim dividend declared by the board when sufficient reserves exist, or a capital reduction supported by a solvency statement if appropriate. Document the investor's veto through a shareholders agreement and, if necessary, bespoke articles. Warn that vetoes must not paralyze the company. Close with filings, update the register of members, issue certificates, file the confirmation statement to when due, and maintain the PSC register if ownership crosses thresholds. Consider a secured lending scenario. A manufacturer seeks a term loan secured by a fixed charge on its factory and a floating charge over stock and receivables. A second lender offers a receivables-only facility. Explain that the first lender's fixed charge will take priority over the factory. Both lenders may compete over receivables. If the first lender's floating charge contains a negative pledge, the second lender may be restricted to a floating charge unless it obtains the first lender's consent or a deed of priority.
Registration must be made within the deadline for both charges. If the company fails and goes into administration, the expenses of realizing the collateral will be paid from the sale proceeds, the fixed charge holder will then be paid from the factory sale, preferential claims will come from floating charge realizations, the ring-fenced prescribed part will be set aside for unsecured creditors, and only then will the floating charge holders share the residue according to their agreed priorities. If just before administration the company repaid a loan to a connected creditor or sold stock at a discount to an associated distributor, apply the relevant avoidance powers and the look-back windows. Try an insolvency tilting governance problem. The board knows the company cannot meet rent in 90 days and a loan covenants will trip next month. A director proposes paying his consultancy arrears and a friendly supplier now and pushing payroll and HMRC. Explain that as insolvency looms, the directors must prioritise creditors' interests and that paying selected creditors who are connected or friendly risks preference claims. Advise convening a board meeting, taking advice from an insolvency practitioner immediately, exploring a moratorium while negotiating with the lender, and avoiding transactions at an undervalue. If rescue is viable, consider administration or a restructuring plan. If not, move to a creditor's voluntary liquidation rather than trading on and risking wrongful trading allegations. Record deliberations minutely, showing that you considered creditors, explored options, and acted promptly.
The buyer and seller in a share sale ask you to act for both to save costs. They appear friendly, but there are rumblings about warranties and an earn-out. Explain that you cannot act for both on opposite sides of a transaction unless stringent conditions for a permitted exception are met, and even then only with informed consent and robust safeguards. Offer to act for one side only and refer the other to independent advice. Later, the buyer urges you to pay part of the price from your client account before completion because it's all agreed on WhatsApp. Decline. Client money is not a float or a favour. Without a concluded contract and completion mechanics, you cannot release funds, and you certainly cannot do so to fix a commercial problem of your client's making. Examcraft. Understand the vocabulary of the FLK syllabus, authority to allot, disapplication of preemption, distributable profits, unlawful distribution, solvency statement, off-market buyback, substantial property transaction with a director, transactions at an undervalue preference, crystallization, prescribed part, ring fencing, pari passu, members' voluntary liquidation, creditors' voluntary liquidation, moratorium, administration, CVA, restructuring plan, unfair prejudice, derivative claim, stamp duty and SDRT. If numbers are given, do the arithmetic carefully. If dates are present, test deadlines, look back periods, limitation and filing windows. If ethics flickers anywhere, pause and deal with it. When rates and thresholds matter for tax or VAT, apply the rates supplied with the question and use the correct computational steps.
The SQE will not reward you for encyclopedic recitation. It will reward you for ticking the right box. That means identifying the precise approvals and documents for the transaction described, knowing when a distribution is prohibited, securing the lender's position with the right charge and the right registration, reading and explaining a balance sheet with enough confidence to support a director's solvency statement, picking the appropriate rescue tool instead of defaulting to liquidation, and never losing sight of professional conduct, client money, conflicts, confidentiality, and money laundering. If you rehearse these moves until they feel natural, FLK business law stops being a wall of text and becomes a series of solvable, mark-rich puzzles. Your task is not to be a walking Companies Act. Your task is to emerge like the safe pair of hands who knows what must be done next, who must approve it, what must be filed, and what must be avoided. Keep that voice in your head in the exam, and you will find that even the thorniest fact patterns yield to orderly, applied, professional analysis. If you found this useful, have a look round Dr. Yannis' channel for more.
In England and Wales, every legal dispute is a story waiting for an ending. Some stories end quietly at a mediation table, others play out behind closed doors in arbitration, and a few march all the way to the courtroom. This video is your complete guide to dispute resolution for SQE1. Dr. Yannis will walk you through every step from those first client conversations and pre-action protocols to the moment judgment is enforced. You'll learn how to decide whether arbitration, mediation, or litigation is the right battlefield, how limitation and applicable law shape a claim before it even begins, and how to draft, serve, and defend proceedings the right way. We follow the SRA specification for FLK dispute resolution. We'll unpack statements of case, interim applications, case management, disclosure, evidence, trial, costs, appeals, and enforcement. We look at 10 key areas covering everything the examiner expects and everything a newly qualified solicitor must master in practice. So if you're preparing for the SQE1 FLK dispute resolution, stay tuned. By the end of this video, you won't just know the rules, you'll understand how to use them. 1. Analysis of merits of claim or defense.
When a client arrives with a dispute, the first task is to test the problem against causes of action and defences that the courts will recognise, and to decide what can actually be proved on the balance of probabilities. That means identifying the essential elements of the claim or defence, mapping each element to concrete evidence you already have or can realistically obtain, and stress-testing limitation, parties, forum and applicable law before you talk about remedies. Keep the distinction clear between grievances and courses of action. A missed delivery date is not actionable without a contractual term or duty. A reputational slight becomes defamation only if it satisfies publication, reference and serious harm. From the defence side, you interrogate the same elements in reverse. Is there a break in causation, a failure of proof on loss, or a complete answer such as limitation or illegality? And you keep one eye on enforcement from day one. A claim that is technically sound but aimed at a defendant with no accessible assets may not be in the client's interests because cost risk sits behind every step in English litigation. The SQE specification expects you to analyse all of this at the level of a newly qualified solicitor. Elements, evidence, limitation, jurisdiction and enforcement, not just legal labels.
You then build an evidence-led merits memo. Relevance is your compass and weight your destination. Ask what the judge needs to decide and whether each proposed fact helps or hinders that decision. The standard of proof in civil cases is the balance of probabilities. Serious allegations still use that standard, but the court expects cogent evidence commensurate with the gravity of what is alleged. Documentary sources, witness memory, expert input and real evidence are all filtered through proportionality. Will this step move the needle enough to justify the cost and time? The court can exclude even relevant material if admitting it would not assist just resolution at proportionate cost. That is why you plan early, preserve documents, line up witnesses while memories are fresh, and decide whether an expert is really needed or whether the issue is legal rather than technical. If the case relies on the other side's records, consider pre-action disclosure to crystallize strengths and weaknesses before issue. 2. Arbitration, mediation, and litigation as an appropriate mechanism to resolve a dispute. Choosing the right path is strategic. Litigation offers a public forum, precedent, strong coercive powers against parties and non-parties, and a full appellate structure. It can also be slow, expensive, and relationship damaging. Mediation and other consensual processes prioritize speed, confidentiality, creative outcomes, and relationship preservation. They are ideal when parties want control over both process and outcome. Adjudication in certain sectors, such as construction or consumer schemes, delivers a swift decision that keeps money flowing, with scope to revisit later. Arbitration, while sometimes discussed separately from ADR in England and Wales, is the private adjudicative alternative to court. Party-chosen procedure and decision-maker, final binding award, limited grounds of challenge, and powerful domestic and international enforcement under statute and the New York Convention. The right choice turns on what the client values: confidentiality, specialist decision-makers, enforceability abroad, or the need for precedent and court powers over third parties.
Since the Court of Appeal's decision in Churchill v. Merthyr Tydfil County Borough Council, the courts can lawfully stay proceedings or order engagement in non-court dispute resolution where doing so pursues a legitimate aim and is proportionate to the party's Article 6 right to a fair trial. CPR amendments in force from 1 October 2024 embed this approach. Judges must now consider whether to order or encourage ADR when giving directions, and unreasonable refusal can sound in costs. In practical terms, you should advise clients that ADR is not a box tick, but a core step that can be compelled and that will affect the wallet. Record good faith offers to mediate, propose realistic models and timing, and use ADR to refine issues, even if settlement is unlikely. Arbitration has also been modernised. The Arbitration Act 2025 refines the 1996 framework by codifying the arbitrator's duty of disclosure following Halliburton v. Chubb, strengthening summary disposal, clarifying the approach to jurisdiction challenges and emergency relief, and adjusting aspects of arbitrator immunity and the law applicable to the arbitration agreement. None of this alters the essentials. Consent, neutrality, confidentiality, finality, and enforceability remain the selling points. For cross-border counties, these refinements make London arbitration an even cleaner choice when privacy, expertise, and international enforcement are critical.
3. Pre-action considerations and steps. Before you issue, you evaluate limitation meticulously, identify the correct parties and causes of action, and engage with the applicable pre-action protocol, or, where none applies, the practice direction on pre-action conduct and protocols. The objectives are consistent. Exchange sufficient information to understand each other's positions. Make reasonable requests for key documents. Explore settlement, including ADR, and keep the process proportionate. Courts expect compliance and can impose costs or other sanctions for unreasonable failures even on a party who later wins a trial. Where time is tight because of limitation, you can protect the position by issuing and then proposing a standstill on service to allow protocol-compliant engagement, but do not leave service to the last moment without good reason, because validity windows are strict. Remember that Welsh language rights apply in civil proceedings issued in Wales. Plan for language requirements from the outset. Use the pre-action phase to shape merits, identify what you must prove and what the other side must prove. Ask for the documents that matter, consider a targeted expert scoping letter, and table a realistic ADL proposal with timing that fits the evidence timetable. If you need pre-action disclosure to do justice or save costs, apply early. If enforcement will later matter, discreetly check asset positions and insurance. Clients should understand that sensible pre-action work is an investment. It narrows issues, avoids ambush, and often pays for itself in settlement savings.
4. Commencing, responding to, or progressing a claim. Proceedings begin with claim form, followed by particulars of claim if not served with it. Draft concisely but with enough detail to show the legal basis and factual core. For defendants, acknowledgements and defenses run on tight timetables. A defense must engage each allegation with admission, denial and reasons, or non-admission with reasons, and raise any positive case and any counterclaim. Jurisdiction challenges must be taken promptly and in the prescribed way. If the defendant does nothing, the claimant can seek default judgment. Setting it aside later hinges on promptness and a real prospect of success. Discontinuant, Tomlin orders, and Part 56 offers are all procedural tools for ending or reshaping litigation in a controlled way. The theme across all of this is discipline, pleadings that define issues, service that complies with the rules, and proactive management of deadlines. Service is jurisdictional. Within England and Wales, follow approved methods and note deemed service dates. The claim form is valid for service for 4 months from issue. Let that expire without good reason, and you may face strikeout. For service out of the jurisdiction, decide whether permission is required, identify a gateway, address forum convenience, and use an appropriate method under the foreign state's rules or applicable convention. Where orthodox service is impracticable, seek alternative service with evidence of diligent attempts and a proposal that is likely to bring the documents to the defendant's attention. Electronic service requires consent or court order. Don't assume an email address on a letterhead is consent for CPR service.
5. Case management and any interim applications relevant to a claim. After statements of case close, the court allocates to a track. Today there are 4. Small claims for the lowest value disputes, fast track for straightforward cases typically listed for a one-day trial, the intermediate track introduced with the extended fixed recoverable costs regime for simpler mid-value cases up to around £100,000, and the multi-track for complex or higher value litigation. With allocation comes a directions timetable covering disclosure, witness statements, experts, and trial windows. The court's case management powers are exercised to further the overriding objective, which now sits alongside an explicit policy of encouraging or ordering ADR where appropriate. Non-compliance attracts sanctions, and relief from sanctions depends on seriousness, promptness, and the overall justice of the case. Interim applications are part of the court's toolkit to keep cases fair and efficient. Summary judgment is available where a claim or defense has no real prospect of success and there is no other compelling reason for a trial. It requires focused evidence and careful calibration of what is law and what is disputed fact. Interim payments deliver part of a likely monetary judgment early where liability is strong. They require robust evidence on liability and quantum. Interim injunctions preserve the status quo where there is a serious issue to be tried. Damages would be inadequate, and the balance of convenience favors restraint, backed by a claimant's undertaking in damages. The evidence for injunctions must be full and fair, especially without notice. Directions hearings routinely consider whether to order or encourage ADR. Courts now treat ADR as a mainstream case management step, not a side road.
6. The evidence needed and disclosure steps required in commencing, responding to, progressing, or defending a claim. Evidence should track the issues, start with what must be proved and by whom. The legal burden aligns with the party making the assertion. The evidential burden is the practical obligation to adduce enough material to put the point in play. The standard remains the balance of probabilities, even for serious allegations, but courts expect stronger, more cogent material where allegations are grave. Relevance admits evidence, weight determines its impact. Judges actively manage evidence to avoid cost and delay. This means narrowing issues early, confining expert questions to what truly needs expert input, and focusing witness statement on first-hand facts rather than commentary or argument. Disclosure is proportional. Standard disclosure requires each party to disclose documents on which it relies that adversely affect its case or another party's case, or that support another party's case, including electronic material. Directions may adopt different disclosure models to scale effort to the dispute. Privilege protects legal advice, litigation preparation, and without prejudice communications. Waive privilege only deliberately and with a plan. Pre-action disclosure can save costs and clarify merits, and non-party disclosure is available where necessary and proportionate. Hearsay in civil proceedings is admissible under the Civil Evidence Act 1995, but you should still consider fairness and reliability and serve notices where appropriate. Hearsay's weight depends on circumstances, such as the ability to call the maker and the quality of the record. If disclosure fights arise, applications for specific disclosure must be targeted, showing that the classes sought are likely to exist and are proportionate to the issues and sums at stake. Witness statements must be in the approved form, containing only what the witness could say orally, and be verified by a statement of truth. Their purpose is to replace evidence in chief, so that trial times is used for cross-examination and submissions. When memory is at risk, refresh with contemporaneous documents in accordance with the rules and guidance. Experts are permitted by court order under CPR Part 35, owe duties to the court, and must be impartial. Courts increasingly use single joint experts in proportionate cases and may ask experts to meet and produce a joint statement of matters agreed and not agreed. Ethical constraints are strict. Solicitors do not shape testimony, they prepare witnesses to tell the truth clearly. Experts must stay within their expertise and explain their methodology and data so the court can test reliability.
7. Preparation of a case for trial, the trial and any post-trial steps. Preparation accelerates as trial approaches. You complete pre-trial checklist confirming readiness, crystallizing outstanding applications, fixing time estimates, interpreters, and any special measures. The claimant prepares a trial bundle that is paginated, indexed, and compliant with directions, ideally agreed to avoid duplication. Skeleton arguments help the judge navigate the issues quickly and anchor oral submissions. A trial evidence-in-chief is usually by witness statement. Cross-examination tests reliability and credibility. Re-examination clarifies it does not repeat. Experts may give concurrent evidence if ordered, focusing on the true points of difference. Courtroom etiquette matters because it supports clarity, modes of address, when to rise, how to handle objections, and how to pace submissions, so the judge can follow the logic. Judgment may be given immediately or reserved. Orders follow, dealing with remedies, interest, costs, and compliance deadlines. You must then switch quickly to consequential matters. If money is due, consider time to pay or immediate enforcement. If an injunction was granted, advise meticulously on the terms to avoid contempt. If specific performance was ordered, calendar the steps and monitor them. Keep settlement in view even at the door of the court. Part 23 and other structured offers can resolve disputes late with clear cost consequences, and courts continue to encourage mediation at every stage. If appealable errors are apparent, move fast on permission and stays. Appeals are not reruns, but focused challenges to error. 8. Procedures and processes relevant to costs involved in dispute resolution. Costs discipline starts at day 0. Budget the case if budgeting applies, file on time, and keep budgets realistic. The expanded fixed recoverable costs regime now covers the fast track and the newer intermediate track, calibrating what can be recovered to the work band and complexity. This should shape litigation tactics from pleadings to experts. Inter-parties costs are usually awarded to the winner, but the court's discretion is wide and conduct matters. Pre-action compliance, compliance with directions, and a party's approach to ADR all influence outcomes. On assessment, standard basis allows only reasonable and proportionate costs, with doubt resolved in favor of the paying party. Indemnity basis is available where conduct justifies it and reverses that doubt. Security for costs protects defendants facing impecunious claimants. Non-party costs orders remain available against funders or others who control litigation.
Part 36 is a powerful lever. Beating your own Part 36 can unlock enhanced interest and cost uplifts, while failing to beat the opponent's offer can be painful. Recent adjustments align Part 36 with the fixed recoverable costs landscape and track structures introduced in October 2023 and refined in 2024. Courts will also now readily reflect unreasonable refusal to mediate in costs following Churchill and the 2024 CPR changes.
9. Appeals. An appeal challenges error, not outcomes you dislike. Identify the right appellate route and the need for permission. Grounds must show an error of law, a wrong exercise of discretion, or a plainly wrong evaluative conclusion. A mere disagreement with findings of primary fact rarely succeeds. Time limits are tight. Preserve your position immediately after judgment by indicating an intention to appeal if appropriate and seeking a short stay only where merits and prejudice justify it. Skeleton arguments must be disciplined and cross-referenced to a lean, accurate bundle. In arbitration, routes are narrower because finality is a core feature. Post-2025 changes clarify how Section 67 jurisdiction challenges are run and tighten aspects of appealability, while serious irregularity remains a high bar.
10. Enforcement of money judgments. Enforcement strategy is asset-led. If the debtor has goods, writs or warrants of control allow enforcement officers to seize and sell. If there is steady income, consider an attachment of earnings. If money sits with a bank or a trading counterparty, a third-party debt order can intercept it. If there is land, a charging order secures the debt, and an order for sale may follow if proportionate. Orders to obtain information can compel the debtor to attend court to answer on oath about assets. Evasiveness risks contempt. For specific performance or injunctions, committal powers back the order. Each route has cost, speed, and impact profiles. Select the one that matches the debtor's footprint and the client's risk appetite, and avoid spend that outstrips recovery. Where a foreign award or judgment is involved, consider recognition routes, New York Convention for Arbitrary Awards, common law or statutory schemes for foreign judgments. Build enforcement planning into the case from the start. It guides offers, timelines, and the choice between litigation, ADR, and arbitration.
Additional integrations the SRA expects across topics: parties, causes of action, applicable law, and specialist courts. Across every stage, you must be precise about parties. Identify the real contracting entity, successors, assignees, insurers, and necessary co-defendants early, because late joinder can collide with limitation. In cross-border disputes, Rome 1 and Rome 2 can point you to a foreign law that must be pleaded and proved as fact. Factor that into cost and expert planning. Choose the right forum: counter court for most straightforward disputes, high court divisions for complex or higher value business, and specialist lists such as the commercial court or the technology and construction court when their procedures and expertise add value. If proceedings are in Wales, plan for Welsh language rights from the start so hearings, documents, and interpretation are set up properly. Bringing it together for SQE1 candidates. The way to excel in dispute resolution is to treat the syllabus as the logic of practice. Start with merits you can prove and a remedy you can enforce. Use the pre-action stage to narrow issues and set up ADR. Choose litigation, mediation, and arbitration for reasons tied to your client's goals. Plead with discipline, serve correctly, and take case management seriously. Build an evidence plan that matches the issues and the proportionality lens. Prepare for trial like an editor, not a hoarder. Budget, use Part 36 intelligently, and manage costs and risks from the outset. When judgment comes, move directly to compliance or enforcement and appeal only where genuine error can be shown. That is the modern English model: fair, efficient, proportionate, and now explicitly ADR forward, and it is the model the SRA expects you to demonstrate in the exam and in practice. Thank you for watching, and see you all next time.
Don't you wish sometimes teenagers would just keep quiet? Could you contract with them to that effect? Welcome to our presentation on English contract law, specifically designed for candidates to the SQE1. This video presents 7 key topics in the English law of contract as per the SRA specification for SQE1. In White v. Blewett from 1853, a dad tried to do exactly what we described earlier. He agreed to pay his son to get him to stop whining. Did it work? Well, it worked for the dad, as he got some peace and quiet. And the court ruled that he didn't have to pay anyway. This presentation was prepared by Dr. Yannis. Have a look around his YouTube channel for more videos focused on key SQE topics.
1. Existence and formation of a contract. Let's start with the basics. A contract usually comes into being when one person makes a valid offer, and the other person accepts it without quibbling. Think of it as a neat handshake. One side says, "I'll do this if you agree," and the other says, "Yes, exactly that." An offer, by the way, has to be clear. It's a promise to be bound if the other side accepts. But here's the catch. Not everything that looks like an offer is actually one. Shop shelves, adverts, the tempting 50% off posters in a window. Those are what we call invitations to treat. They're more like a wink than a marriage proposal. Come make me an offer and I'll think about it. Now, acceptance has to mirror the offer. Lawyers call this the mirror image rule. If you start changing the terms, you're not accepting, you're making a counteroffer. And the moment you do that, the original offer goes poof, gone forever. On the other hand, just asking a question, can you deliver a bit earlier, that doesn't count as a counteroffer. That's just fishing for information. Usually, acceptance has to be communicated. If you just think, yes, I agree, in your head, that's not going to cut it. But for unilateral offers, like those reward posters you see in the movies, £1,000 for the safe return of my dog, you can accept by performance. Bring the dog back, and you've accepted, no words needed. There's also the quirky postal rule. If you send your acceptance by post, it counts as effective from the moment you drop it in the letterbox, not when it arrives. In the digital age, though, most contracts specify how acceptance works, and for things like email or messaging, acceptance only really lands when it's received. Speaking of the digital age, here's a practice note. In online shopping, those click-wrap terms, you know, the ones you never read before hitting buy now, usually form part of the contract, so long as they're presented clearly. The golden rule for businesses is make sure the terms are visible before people click purchase, and don't let your auto-confirmation email say something different. Nothing screams litigation like mixed messages. So far, so good. But a contract isn't complete without consideration, the something of value exchanged. It doesn't have to be a fortune, it just has to be legally sufficient. Famously, even a peppercorn will do, if that's what the parties agreed. Sometimes the something is forbearance, promising not to sue, for example, if the claim is arguable. But watch out, past acts don't count, unless they were done at the promisor's request with an expectation of payment. Now, what about promising to do something you're already obliged to do? Traditionally, that's not new consideration, but modern courts have been more flexible. If repeating the promise gives the other side a practical benefit, like avoiding delays or penalties, then it might count after all. Still, don't get too excited. When it comes to paying off debts, the old rule remains firm. Part payment alone won't wipe the slate clean. Then there are the no oral variation clauses, the we can only change this in writing rule. The Supreme Court has confirmed these clauses work, although courts sometimes use estoppel to stop a party from playing hardball where it would be unfair. And that brings us neatly to promissory estoppel. It's a shield, not a sword. You can use it to stop someone enforcing strict rights if they promise not to, and you relied on that promise. But it won't give you a brand new claim all by itself.
On the question of intention, commercial agreements are presumed to be binding, social and domestic arrangements are presumed not to be, but both presumptions can be flipped. A couple drawing up a separation agreement, that's serious business. A business contract marked binding in honour only, that's much less serious, though courts look closely at wording like that. Courts generally want to uphold bargains. They won't rip up a deal just because some details are missing, but key terms, price, subject matter, who's involved, need to be clear enough to work with. An agreement to agree later is usually too vague unless there's a built-in mechanism to make it concrete. Finally, capacity. Not everyone can enter contracts on the same footing. Minors, drunk at the time, or those lacking mental capacity are protected. Minors are bound for necessaries, essentials appropriate to their station in life, and beneficial contracts of service, like apprenticeships. Otherwise, many contracts are voidable at their choice. As for companies, they have separate legal personality, and modern law generally protects outsiders dealing with them in good faith, even if directors overstep their internal authority. So, contracts are about matching offers and acceptances, making sure something of value passes between the parties, and ensuring the deal is intended and capable of being legally binding. The law's aim is to respect bargains, but with a few guardrails to stop things going off the rails.
2. Privity and third-party rights. Now let's talk about privity. This is one of those classic contract law rules that sounds simple, but in practice caused headaches for decades. The idea is this: only the parties to a contract can enforce it. So if you're not actually on the contract, you can't sue on it. Seems tidy? Right. Except it often led to absurd results. Imagine this. You've got a contract that's clearly meant to benefit someone else, a family member, a supplier, a customer down the line. Under the old common law, that person was left high and dry. They got the benefits in theory, but no right to enforce it.
It was a bit like being promised a slice of cake, only to be told, sorry, you're not invited to the party. To fix this, the law developed two safety valves. The first was good old-fashioned legal creativity. Courts came up with workarounds, collateral contracts, agency arrangements, trusts of a promise, even covenants that run with the land. In other words, judges bent over backwards to stop obviously unfair outcomes. The second and far more straightforward safety valve came from statute. Today, under modern law, a third party can enforce a contract if they're identified by name or by a class or description, and if the contract either explicitly says they can, or, when you read it carefully, it clearly intends to give them a benefit. That's a big shift. Suddenly, the person promised a slice of cake can actually claim it. Of course, parties still get a choice. If they don't want third parties muscling in, they can opt out by saying so explicitly. No third-party rights intended. And in practice, that's exactly what many commercial contracts do. It avoids surprises later. So here's a drafting tip. Be clear. Either spell out that a particular third party has rights, name them or describe them properly, or exclude third-party rights altogether. Ambiguity is an open invitation to litigation. And if you do end up in court, what matters is the wording and the commercial context. Judges have shown they're perfectly willing to allow third-party enforcement if the language and structure of the deal point that way.
3. Contents of a contract. Let's move on to contract terms, how they actually make their way into the deal. There are three main routes. The first is by signature. If you sign a contractual document, you're generally bound by it, unless there's fraud or misrepresentation. It's the classic you signed it, you own it rule. The second route is by notice. Terms can be incorporated if they're brought to your attention before the contract is made. The more unusual or onerous the clause, the louder you have to shout about it. Judges have said, only half-jokingly, that some terms need a red hand pointing to them. If you're hiding a nasty surprise in the small print, don't expect a court to back you up. The third way is through a consistent course of dealing. If two parties have done business repeatedly on the same terms, those terms can be taken as incorporated into future contracts, even if not spelt out each time. Where things get tricky is in automated settings, ticket machines, car parks, online portals. The later you reveal a term, the less chance it has of sticking. Springing it after someone has already committed is usually too late. Beyond express terms, courts sometimes step into implied terms. This isn't about rewriting contracts, but about making them workable. If a deal just doesn't function without a missing piece, the law may supply it to give business efficacy. Lawyers often explain this with the officious bystander test. If an imaginary bystander suggested the term at the time, both parties would have said, oh, of course, that goes without saying. Still, implied terms are exceptional and always depend on context. Statute goes much further, especially in sales and consumer law. Whole bundles of terms are implied automatically. Goods must be of satisfactory quality, fit for their purpose and match their description. Services must be carried out with reasonable care and skill. And consumers often have repair or replacement rights built in. Whether businesses can contract out of these obligations depends on the statutory regime, and usually there's a test of reasonableness or fairness standing guard. Interpreting terms is another delicate business. Courts now ask, what would a reasonable person with the relevant background knowledge understand the words to mean? Modern interpretation tries to strike a balance between the text and the context. Clear wording is powerful, but if ambiguity creeps in, commercial common sense plays a role. What courts won't do is rescue you from a bad bargain. They won't rewrite a contract just because one side made a poor deal. And finally, variation. Contracts can be changed if the parties agree, but many modern agreements include no oral variation clauses. These say changes must be in writing and signed. The Supreme Court has backed their enforceability on the basis that commercial certainty is worth protecting. That said, equity has its own safety valve. If one party relied on a clear oral promise, and it would be unfair to backtrack, estoppel can prevent the other from insisting on the strict rule.
We now turn to exemption clauses and statutory control of unfair terms. Exclusion and limitation clauses are where contracts get a little spiky. These are the terms that try to cap liability, carve out certain losses, or set strict time limits for bringing claims. The law doesn't ban them outright, but it does insist on two things. First, the clause has to be properly incorporated into the contract, and second, it has to be clearly drafted. If there's any ambiguity,
Courts still tend to construe it against the party relying on it, the old "you wrote it, you deal with the full-out" principle. That said, in modern commercial contracts between sophisticated businesses, judges are less sympathetic to cries of unfairness. If two well-lawyed companies sign up to clear words, the courts will usually give effect to them. The old Canada steamship rules, which made it difficult to exclude negligence, have largely been toned down in that context. The question now is more straightforward. What does the clause, read in its context, actually mean? But here's the catch. The harsher the term, the more clearly you need to spell it out. If you're hiding a strict liability cap or a tough exclusion in the small print, don't be surprised if the court refuses to enforce it. The more unusual or onerous the clause, the more prominently it needs to be flagged. Overlaying all of this are statutory controls. In business-to-business contracts, the Unfair Contract Terms Act, UCTA, sets in. It flatly prohibits excluding liability for death or personal injury caused by negligence. For other types of loss, it applies a reasonableness test. Standard form attempts to exclude liability for breach or non-performance are scrutinized carefully. For consumer contracts, the Consumer Rights Act sets an even broader fairness test. A term is unfair if, contrary to good faith, it creates a significant imbalance to the detriment of the consumer. Clauses about core terms like price or subject matter escape this fairness test only if they're transparent and prominent. If they're buried in a footnote, they won't survive. And a quick note on misrepresentation: entire agreement clauses and non-reliance clauses can't be used as a magic shield to wipe out liability. They too have to pass the relevant reasonableness or fairness tests. In practice, courts sometimes uphold clauses that look tough on paper, but only if they reflect a genuine commercial interest and were presented clearly. The bottom line is this: in business deals, clarity and context matter most. In consumer contracts, fairness rules the day.
4. Vitiating factors. Let's unpack misrepresentation, the law's way of dealing with false statements that lure people into contract. At its core, an actionable misrepresentation is an unambiguous false statement of existing fact or law that actually induces the deal. Not all statements are created equal. Expert opinions can cross the line into fact when they carry implied assurances, and promises about the future can count if, at the time they were made, the speaker never intended to keep them. Silence is usually safe, but not always. If something you said was true on Monday and becomes false by Friday before the contract is signed, you may have to correct it. And in some relationships or types of contract, historically insurance is the poster child, the duty to disclose goes further, now reframed in commercial insurance as a duty of fair presentation rather than omniscient confession. What can a misled party get? Two main tools: rescission, which rewinds the contract as if it never happened, and damages. Fraud opens the door to tort-style damages for all direct loss flowing from the deceit. Statutory negligent misrepresentation sits in the middle. The maker of the statement has to show they had reasonable grounds to believe it was true, and if they can't, damages can be generous. Innocent misrepresentation is the gentler end of the scale, where the court has a discretion to award damages instead of unwinding the contract if that's the fairer outcome. There are also practical breaks on rescission. If you affirm the contract, wait too long, can't put the parties back substantially where they started, or third-party rights have intervened, the reset button may be disabled. And don't assume you can draft your way out. Clauses trying to exclude or limit liability for misrepresentation have to pass statutory tests of reasonableness or fairness. Calling something a non-reliance clause doesn't make it magic. Courts look at substance, not labels. Now, mistake: the law's attempt to mop up when both sides were talking about different realities. Common mistake, where both parties share the same fundamental error, can make a contract void, but only in narrow scenarios, typically when the subject matter doesn't exist or the deal is radically different from what both imagined. Mutual mistake, genuine ships-in-the-night misunderstanding, can prevent a contract from forming at all, because there was never true agreement. Unilateral mistake is trickier. If one party is mistaken and the other knows or ought to know, and the mistake goes to the very terms or identity, the contract may be void for want of real consent. Disappointment about quality rarely qualifies. Equity's broader power to relieve for mistake has been reined in, but rectification remains available where the written document misrecords a prior common intention that persisted up to signature. In everyday life, the real protection is prosaic. Careful checks before signing and well-drafted warranties. Courts are reluctant to use mistake as an all-purpose safety net.
Pressure next. Duress is about consent extracted the wrong way. It ranges from the obvious threats to the personal property to the modern workhorse, economic duress. That's where one party uses illegitimate commercial pressure, like threatening a breach to force a better deal without good reason. Courts look for a lack of practical choice, a causal link between the pressure and the agreement, and signs the victim protested and acted promptly once the pressure lifted. Undue influence is a cousin concept, focusing on relationships where influence is misused. It can be proved directly or presumed from the nature of the relationship and the facts. In the classic family guarantor scenario, lenders are treated as being on inquiry. To keep the security enforceable, the surety must usually receive independent advice so the decision is genuinely theirs. If that safeguard is missing, the guarantee may not stick. Finally, illegality, the point where the court steps back, not to reward anyone but to protect the integrity of the legal system. The modern approach is principled rather than mechanical. The question isn't simply, was there something unlawful? It's, would enforcing this claim damage the integrity of the law? To answer that, courts look at the purpose of the rule that's been breached, any other public policies in play, and whether denying relief would be proportionate. Illegality can taint a contract at different stages. At formation, the object or required performance is prohibited. In performance, a lawful bargain carried out unlawfully, or through restraints that offend public policy, or agreements to commit a civil wrong or crime. The remedies are flexible. Sometimes the claim is refused outright. Sometimes restitution is allowed to unwind an unjust enrichment. Sometimes limited contractual recovery is permitted if it doesn't undermine the policy at stake. Think of a secret commission arrangement. Even if services were valuable, a claim depending on the claimant's own wrongdoing is likely to be refused. By contrast, if illegality is incidental and denying any remedy would hand the other side a windfall out of all proportion, a carefully tailored response may be allowed. Running through all of this is a reminder that lawyers, like their clients, operate under ethical duties. Courts won't be used to sanitize wrongdoing, and professional standards expect integrity rather than clever workarounds.
5. Termination. Not all contracts end with drama. Many simply expire with the calendar. Termination by a fluxion of time happens when a fixed-term contract reaches its end date, or when a condition built into the agreement is triggered. For example, a deal lapses if regulatory approval doesn't come through by a long stop date. Clarity at the outset is key. If there's an option to extend, the contract needs to spell out who exercises it, how, and when. If there's a break right, the notice requirements need to be precise. Courts are strict on this. Get the notice machinery wrong, and your attempt to terminate might not count at all. Some contracts hinge on conditions. Conditions precedent suspend enforceability until they're satisfied. Conditions subsequent can bring an obligation to an end if a specified event occurs. And remember, when a contract ends, some terms outlive it. Confidentiality, intellectual property licenses, restrictive covenants, and accrued rights often survive termination. Sometimes the contract says so explicitly, other times courts infer survival from context. Termination can also come from breach, but only if the breach is serious enough. A repudiatory breach gives the innocent party a choice: either affirm the contract and demand performance, or accept the repudiation, terminate, and claim damages. Whether a breach is repudiatory depends on the term and its effect, if it's a condition that goes to the root of the bargain, or if the breach deprives the innocent party of substantially the whole benefit, it qualifies. But tread carefully. If you want to terminate, give a clear notice identifying the breach and your decision to accept it. Mixed signals or delay can be treated as affirmation, and once you affirm, the right to terminate for that breach is gone. Anticipatory breach is the cousin situation where one party makes it clear before performance is due that they won't perform. The other side can terminate immediately and sue, or keep the contract alive and insist on performance. Keeping it alive carries risk, though. If circumstances later make performance impossible without the defaulting party's fault, the claim may vanish altogether. Courts also expect the innocent party to have a legitimate interest in insisting on performance, not just a desire to punish. After termination for repudiatory breach, rights that have already accrued remain.
Clauses on liquidated damages, for example, may continue to apply, but it depends on the wording. Some clauses run until completion, which means they may stop applying once the contract ends. Others are drafted to bite even after termination. Courts emphasize the primacy of language here. It's all about what the parties actually agreed. Then there's frustration, the legal doctrine for when performance becomes impossible or the obligations transform into something radically different through no fault of either party. It's not an escape hatch for a bad bargain or mere hardship. Extra expense, foreseeable risks, or routine delays rarely qualify. If the contract already allocated the risk with a force majeure clause or a price adjustment, frustration won't step in. When it does apply, the discharge is automatic. Future obligations fall away. The Law Reform Frustrated Contracts Act 1943 then steps in to sort out money and benefits. Sums paid are recoverable, sums due cease to be payable, and courts can make allowances for expenses or benefits conferred before discharge. Still, the smarter move is to draft a robust force majeure clause. That way your client controls the consequences rather than relying on a blunt doctrine.
Finally, restitution, the law's safety net when contracts unravel. It aims to stop one side being unjustly enriched once the contractual framework has collapsed. 3 patterns come up again and again. First, total failure of consideration. Someone pays for performance but receives nothing of substance, like paying for goods that never arrive. They can usually reclaim the price, though courts apply common sense. Minor or incidental benefits may block recovery. Second, quantum merit, where performance has been conferred, but the contract ends before completion. If the recipient freely accepted the benefit, the provider can often claim a reasonable sum for the value delivered, unless the contract was an all-or-nothing bargain. If the other side uses the part performance, the law normally expects payment for it. Third, situations where payment is conditional and the condition fails. Courts are reluctant to use unjust enrichment to rewrite those risk allocations. If the contract says payment only if X happens and X never happens, recovery is unlikely. The Supreme Court has been clear, unjust enrichment won't be used to give someone a price the contract expressly withheld. If a client wants a fallback payment for valuable services, it has to be drafted in. The key across all of these is knowing when the contract governs and when restitution takes over. Plead the right cause of action, don't dress up restitutionary claims as contractual ones, or vice versa. And always consider possible defenses like set-off or change of position, which can reduce recovery.
6. Remedies. Damages in contract are, at heart, restorative rather than punitive. The aim isn't to fine the breacher, but to put the innocent party, so far as money can, into the position they would have occupied if the promise had been kept. 3 measures do most of the work. Expectation damages capture the lost bargain. Reliance damages reimburse wasted expenditure when profits are too speculative to prove. And, in rare outliers, the law may strip gains from the wrongdoer with a restitutionary or gain-based award. Expectation can be calculated in 2 familiar ways: the difference in value between what was promised and what was delivered, or the cost of curing the defect. Courts dislike economic waste, so if rebuilding the house to move a wall 3 inches would cost a fortune for little practical benefit, they may refuse the cost of cure and award a modest difference in value or a sum for loss of amenity instead. Reliance steps in when profit projections feel like horoscope reading. It returns reasonable expenditure subject to the breaching party showing the venture would have lost money anyway. As for gain-based awards, they're exceptional, reserved for situations where conventional measures misfire and there's a strong policy reason to make the contract breaker hand over profits. What about non-financial upset? Generally, contract damages don't pay for distress. There are narrow exceptions where the very object of the contract is pleasure, relaxation, or peace of mind, or where physical inconvenience is caused. In commercial deals, such awards are rare guests. 2 guardrails shape every damages claim. Causation asks the simple counterfactual: would this loss have happened but for the breach? The chain can be broken by a truly independent intervening event. Remoteness is the filter of foreseeability. Was this kind of loss within the reasonable contemplation of both parties when they contracted? Losses that arise naturally in the ordinary run of things are recoverable. Losses that depend on special circumstances are recoverable only if those circumstances were shared. Modern cases also ask whether the defendant can fairly be taken to have assumed responsibility for that type of loss, an idea that can narrow recovery in specialist markets. Sometimes the parties price the breach in advance.
Liquidated damages clauses fix a sum payable on the breach. Bonds and similar instruments may pay out on a specified event regardless of breach. The courts respect commercial risk allocation but draw the line at penalties. The modern question is whether the clause protects a legitimate business interest and whether the sum is proportionate to that interest. The old genuine pre-estimate of loss remains a strong clue to validity, but it's no longer the whole test. Money doesn't always suffice. Specific performance is the court's power to say, do the thing you promised. It's discretionary and used where damages are inadequate, land, genuinely unique goods, or contracts where a substitute simply can't be sourced. Limits apply. The court won't order performance that requires constant supervision, imposes undue hardship, offends equity, or amounts to compelling personal services. Show that money won't do, and that the obligation can sensibly be policed, and the case for specific performance strengthens. Injunctions sit alongside this. A prohibitory injunction restrains a threatened or continuing breach, think a reasonable non-compete of limited time and scope, or a promise not to disclose confidential information. Mandatory injunctions compel positive steps to undo a breach, but courts are more sparing there. Negative obligations are easier to enforce than positive ones, especially where an order won't, in substance, force unwilling partners to continue a relationship of trust. Interim relief is fast-moving, speed matters, damages must be inadequate, and applicants typically give a cross-undertaking to compensate if it turns out the order shouldn't have been granted.
There's also the quiet workhorse of contract law mitigation. Once breach happens, the innocent party must take reasonable steps to limit their losses. No one has to take reckless risks, but they can't sit back and let damages snowball. If a reasonable substitute is available, they should take it. If they don't, recovery is limited to the loss they would have suffered had they mitigated. Sometimes mitigation produces a net benefit. Say the replacement kit is more efficient and cuts costs. Those gains can be set off so long as they flow directly from sensible mitigation rather than being collateral windfalls. In business-to-business settings, indemnities aren't treated as exclusions, but statutory controls still bite if they attempt to exclude liability for death or personal injury caused by negligence, or, on the consumer side, if they create a significant imbalance under fairness rules. Notice, conduct of claims provisions, any duty to defend, and the relationship with liability caps all shape how an indemnity works in practice. Guarantees look similar but behave differently. A guarantee is a secondary obligation. The guarantor promises to answer for the debt or default of the principal debtor. Traditionally, it must be evidenced in writing signed by or on behalf of the guarantor. Because it's collateral to the main contract, a material variation of the principal bargain without the guarantor's consent can discharge the surety. By contrast, an indemnity, being primary, tends to ride out variations more easily. At the performance security end, on-demand bonds and guarantees can be autonomous. The surety must pay on presentation of compliant documents, save for fraud. On-demand instruments are different in tone and effect from see-it to guarantees. The label and the language matter. Put together, these doctrines give the court a full toolkit. Money to restore bargain position where that makes sense, equitable orders where only performance will do, and structured mechanisms, penalty-proof sums, indemnities, and guarantees to manage risk in advance. The law's constant refrain is proportion, clarity, and fit. Pick the tool that matches the harm and use it within the boundaries the parties set for themselves.
7. Causation and remoteness. Causation in contracts starts with a straightforward question. Would the loss have happened but for the breach? If the answer is no, the causal link is established. But that's only the beginning. Legal causation asks whether something else has intervened to break the chain. Remoteness then steps in to draw the outer boundary. The law only allows recovery for losses that were within the reasonable contemplation of both parties at the time of contracting as a not unlikely result of breach. Ordinary losses that flow naturally are always in scope. But unusual or high consequence losses, say the kind that wipe out an entire downstream venture, are only recoverable if the special facts were shared in advance and the breaching party can fairly be said to have assumed responsibility for that kind of loss. The modern approach is highly context sensitive. In certain markets, shipping, commodities, financial instruments, industry practice and contractual risk allocation are crucial. If the parties have drafted clauses that exclude loss of profits or carve out indirect losses like wasted management time, then those words shape what was actually contemplated. The analysis starts with the contract's language and then applies the classic principles of causation and remoteness against that backdrop.
Evidence of market practice and the parties' shared project goals often helps courts decide where contemplation and responsibility really lie. Bringing the bigger picture together, 3 habits will keep you safe across illegality, termination, and remedies. First, always anchor your analysis in the words of the contract. Conditions, notice machinery, survival clauses, force majeure, liquidated damages, indemnities, caps, and exclusions. Second, map the timeline. What rights accrued before termination, what terms survive, and what only bite afterwards. Third, frame the loss carefully. Causation, remoteness, and mitigation aren't afterthoughts. They determine the value of the claim from day one. And remember, ethics run through all of this. Courts won't enforce bargains that undermine the law. If termination's on the table, clients need clear warnings about the risks of wrongful termination and the need for precise notices. If indemnities or guarantees are being negotiated, clients need to understand the scope, the caps, and how they interact with insurance. Acting with integrity, protecting confidential information, and watching out for unequal bargaining power are all part of the solicitor's role. The thread running through it all is professional integrity. Don't threaten remedies you can't legally justify. Don't disguise illegality with clever drafting. And do ensure transparency where consumers or vulnerable parties are involved. Keep good notes of the warnings you give, because in both exams and real life, the solicitor's duty is as much about how you advise as it is about what the law says.
So that's the big picture. Contracts are about clear offers and acceptances supported by consideration, with terms that courts will interpret through the lens of fairness, clarity, and commercial sense. Remedies aim to compensate rather than punish, and doctrines like mistake, duress, frustration, and illegality show where the law draws boundaries to protect integrity. At every stage, drafting, performance, or dispute, the words of the contract, the timeline of events, and the scope of loss are what really matter. And underlying it all, both in exams and in practice, is the professional duty to act with integrity, give clear advice, and balance commercial goals with the rule of law. If you enjoyed this video, share it with a friend and press like before you go. Thank you, and see you next time.
Imagine you're walking back home from the supermarket, plastic bag in hand, and you see a peacock running across the street and into someone's garden. You're like, wow, a peacock, I gotta take a pic of that. You talk your bag on the pavement and jump over the fence to be immediately shot in the face. Welcome to a presentation of the English law of tort, where you'll learn why you shouldn't jump over fences and where you'll encounter all key topics required for the FLK of the SQE for aspiring solicitors. And just in case you're tempted to booby-trap your property or wire your scent to the mains to deter burglars, remember the 1828 case of Bird v. Holbrook says that's a hard no.
This video was prepared by Dr. Yannis. He is aiming to make tort law feel practical. It helps to think like a newly qualified solicitor. A client tells you a story, and you must decide what duty was owed, whether it was breached, whether that breach caused legally recoverable loss, which defences might bite, and what remedies are realistically on the table. Along the way, you act honestly, with integrity, and in the public interest under the SRA's principles and codes of conduct. That means not overclaiming, not intimidating litigants in person, and not pleading torts with no reasonable prospects. With that frame in mind, let's begin with negligence, the engine room of tort.
1. The duty of care. Negligence starts with a duty of care. In everyday personal injury and property damage cases, duty is rarely controversial. Drivers owe duties to other road users, doctors to patients, employers to employees. When it is controversial, courts use a few tools. You'll hear people say Donahue v. Stevenson and the neighbour principle. Take reasonable care to avoid acts or omissions which you can reasonably foresee would be likely to injure your neighbour, those closely and directly affected by your acts. In novel situations, courts move carefully using the Caparo three-stage approach. Was harm reasonably foreseeable? Was there a relationship of proximity? And is it fair, just, and reasonable to impose a duty? Policy matters at this edge. Courts are far more cautious about imposing duties for economic losses than for physical injury. Sometimes the better question is not Caparo, but has responsibility been assumed? In negligent misstatement or advisory contexts, auditors, surveyors, professionals, duty often turns on a voluntary assumption of responsibility and reasonable reliance by the claimant. If you advise knowing they will rely, you can owe a duty, even if there is no contract between you. Keep that in mind for pure economic loss and misstatements later. Once you have a duty, ask about the standard of care and breach. The standard is objective, the reasonable person. It flexes with risk, gravity of harm, cost and practicality of precautions, and social utility of the defendant's activity.
If the risk is small and precautions are onerous, the law does not require the world to grind to a halt. If the potential harm is grave, modest precautions become reasonable. Professional defendants are judged against a reasonably competent member of their profession. If a responsible body of opinion supports what they did, that can be evidence they were not negligent, but professional practice has to withstand logical analysis. The court will not rubber stamp poor practice just because several practitioners happen to follow it. When the defendant is an employer, folding a specific content of the employer's primary duty of care. Employers must take reasonable care to provide competent staff, adequate plant and equipment, a safe system of work, and proper supervision and training. That's not strict liability, it's a realistic duty calibrated to the workplace. If a risk is well known, inexpensive to mitigate, and serious if it eventuates, failing to act is likely to be a breach. Documented risk assessments and prompt responses to near misses matter in practice and in court.
2. Causation and remoteness. Assuming breach, turn to causation in fact. Would the harm have occurred but for the breach? Often the answer is clear. Sometimes it isn't, especially with multiple potential causes or cumulative exposures. In single-cause cases, the but-for test does the heavy lifting. In multiple-cause cases, courts sometimes accept material contribution to injury or material increase in risk, depending on the medical evidence and the type of harm. This is not an open-ended invitation to guess. It's a tightly managed exception to avoid injustice where scientific uncertainty makes strict but-for proof impossible. Next is legal causation or novis actus interveniens. Did something new break the chain? Was the intervening act reasonably foreseeable, a natural response to the situation the defendant created, or was it so independent and potent that it fairly shifts responsibility away? A panicked but understandable rescue attempt typically doesn't break the chain. A bizarre criminal intervention might. You assessed sequence with common sense and fairness. Then comes remoteness. The defendant is liable for the kind or type of damage that was reasonably foreseeable at the time of breach. You don't need to foresee the exact mechanism or the full extent. If the kind of injury is foreseeable, the thin skull principle applies. You take your victim as you find them. If a minor impact causes serious harm because of vulnerability, the defendant is liable for the full consequences.
3. Harm and loss. Now, the head of loss. For personal injury and fatal accidents, the principles are well settled. General damages compensate for pain, suffering, and loss of amenity. Special damages for quantifiable past losses and future losses for earnings, care, medical treatment and aids, discounted for contingencies, and accelerated receipt. In fatal cases, claims may include dependency damages for those financially dependent on the deceased, a statutory bereavement award where available, funeral expenses, and the estate's own claims. Always distinguish the estate survival claim from dependence claims. They are conceptually different. Manage client expectations. No one is punished through damages. We restore as money can. 2 tricky negligence topics cause exam pain: psychiatric harm and pure economic loss. Let's simplify psychiatric harm first. The law draws lines. There is no separate tort of nervous shock, but courts insist on control mechanisms. A claimant needs a recognizable psychiatric illness, not mere grief or distress. Primary victims, those directly involved and within the range of foreseeable physical injury, can recover for psychiatric harm if injury of some kind was foreseeable. Secondary victims, witnesses who are not in danger themselves, face further hurdles: a close tie of love and affection to the person injured, proximity in time and space to the event or its immediate aftermath, and direct perception with unaided senses. The law is wary of widening this category because of the risk of indeterminate liability. In practice, be specific about diagnosis, proximity, and the mechanism of injury. Pure economic loss divides the field. If negligence causes physical damage or personal injury, resulting financial loss is recoverable. But if the negligence merely makes a product or building defective, the loss is usually pure economic loss and unrecoverable in tort. It belongs to contract and statutory regimes. That's why claims for the cost of remedying inherent defects in a building tend to fail in tort, unless the defect also causes damage to other property or injures someone. There is an exception for negligent misstatements or services where a defendant assumes responsibility and the claimant reasonably relies. Surveyors who negligently value property, accountants who negligently audit accounts for a known purpose, and professionals who supply information, not mere things,
connote duties in tort for foreseeable economic loss. The exam signals here are reliance, purpose, proximity, and whether the defendant was in the business of speaking with responsibility.
4. Defences. Let's pause and step into defences in negligence. Contributory negligence is the workhorse. If the claimant failed to take reasonable care for their own safety and that failure contributed to the damage, the court reduces damages by a just percentage. Not wearing a seatbelt, ignoring obvious warnings, or mishandling equipment can all trigger reductions. The percentages are often argued fiercely. The point is to share responsibility fairly. Voluntary assumption of risk, valenti non fit injuria, completely defeats the claim if the claimant knew the specific risk and freely agreed to run it. It's not enough that they knew an activity was risky, you need true voluntary acceptance of the particular risk that materialized. Courts use this defense sparingly because contributory negligence allows for a more nuanced apportionment. Illegality is the last of the trio. The modern approach asks whether allowing the claim would harm the integrity of the legal system. Is the tort closely connected to the claimant's serious criminal conduct? Would recovery undermine a coherent set of legal norms? Not every illegal act blocks a claim. The question is whether the court should, as a matter of principle, help the claimant profit from or evade responsibility for their wrongdoing. You must plead and evidence this with care in line with your ethical duties. Alongside primary liability sits vicarious liability. An employer can be liable for the tort of an employee committed in the course of employment. 2 questions. Is the relationship sufficiently akin to employment, and is the wrongful act closely connected to the field of activities assigned to the employee? If yes, vicarious liability spreads loss to the enterprise that benefits from the activity and can insure against it. It's not strict liability for everything an employee does. Frolics of their own and acts wholly outside the assigned field can fall outside. Also, vicarious liability sits on top of the employer's primary duties. You can plead both. Move now to occupier's liability. Think of 2 statutory frameworks. For lawful visitors, the 1957 Act sets the common duty of care. Take such care as is reasonable to see that visitors will be reasonably safe for the purposes for which they are invited or permitted to be there. It's about the state of the premises, not negligent activities happening on them. Negligent activities are analysed under ordinary negligence. Who is an occupier turns on control, not title. Warnings can discharge the duty if they make dangers clear and reasonably safe. Specialists are expected to guard against special risks of their calling. Children are owed a higher standard because they are, by nature, less careful. You can, in some contexts, restrict or exclude liability to visitors with clear wording, but consumer and unfair terms legislation will police that strictly in consumer contexts. For non-visitors, including trespassers, the 1984 Act imposes a narrower duty. Take reasonable steps to protect from injury by a danger on the premises if you know of the danger, know or have reasonable grounds to believe that the non-visitor may come into the vicinity and the risk is one against which you may be reasonably expected to offer some protection. Policy matters. Courts resist turning public spaces into risk-free zones or requiring public bodies to guard against obvious inherent risks of natural features. Bold warnings, barriers, and sensible risk management will often be enough. Valenti can succeed more readily where a trespasser knowingly embraces an obvious danger.
5. Product liability. Product liability in English law really has 2 distinct routes, one based on negligence and one under statute, through the Consumer Protection Act 1987. Let's start with the common law route. In negligence, manufacturers, suppliers, importers, and sometimes even retailers owe a duty to take reasonable care to avoid foreseeable injury or damage caused by defective products. The principle is simple. Anyone who puts a product into circulation, knowing that it will reach the end user without reasonable opportunity for inspection, owes a duty to that ultimate consumer. This was established long ago in the famous case of Donahue versus Stevenson, where a decomposed snail in a bottle of ginger beer triggered modern product liability law. Since then, the duty has expanded beyond drinks and food to virtually anything placed on the market. Electrical appliances, medicines, cosmetics, cars, toys, even digital equipment. To succeed in negligence, the claimant must still prove the familiar 4 elements: duty, breach, causation, and loss. Breach means showing that the producer failed to take reasonable steps to ensure the product's safety, for instance, poor quality control, inadequate testing, or failure to provide proper warnings or instructions. Causation can be tricky, especially where the product has been destroyed by the very defect that made it dangerous. In those cases, courts accept circumstantial evidence and inferences. For example, if a brand new kettle explodes on first use, the court may infer a manufacturing defect even if the kettle itself cannot be tested. However, the claimant still carries the burden of proof. Negligence, therefore, requires evidence about fault, which can make such claims expensive and uncertain. Because of these difficulties, the Consumer Protection Act 1987 introduced a second statutory route, a strict liability regime that removes the need to prove negligence. The Act implements the European Product Liability Directive, and its principle is clear. If a product is defective and that defect causes damage, the producer is liable, even if they exercised all possible care. Under the Act, a product is defined broadly. It includes any goods, raw materials or components, and even electricity. A product is considered defective when the safety of the product is not such as persons generally are entitled to expect. That phrase, entitled to expect, is deliberately flexible. It asks what an ordinary consumer would consider safe, taking all circumstances into account: how and when the product was marketed, any instructions or warnings given, what might reasonably be done with it, and the time when it was supplied. For example, if a new car's airbag fails to deploy in a low-speed collision because of a manufacturing fault, that car is not as safe as people generally are entitled to expect. The manufacturer would be strictly liable for the driver's injuries even if they had carried out extensive quality checks. Similarly, if a child's toy contains detachable small parts not properly labelled as a choking hazard, the producer can be liable for resulting injuries even without proof of carelessness. The Act applies to producers, which includes not only manufacturers of finished goods, but also those who make components, processors of raw materials, and anyone who presents themselves as the producer by putting their name or trademark on the product. Imports into the UK can also be treated as producers. Retailers are usually not liable unless the actual producer cannot be identified, in which case the supplier must provide the claimant with the producer's details within a reasonable time or risk being treated as the producer themselves. What losses can be recovered? The statutory regime covers three main categories: death, personal injury, and damage to property used for private purposes. Property damage is subject to a monetary threshold, currently £275, to avoid trivial claims. The Act does not compensate for pure economic loss. If a product simply fails to work and needs replacement but causes no injury and no damage to other property, the cost of repair or replacement is a contractual matter, not a tort claim. For example, if a washing machine stops working after a few months because of a design fault, the consumer must rely on sale of goods or warranty rights, not the Consumer Protection Act. But if the washing machine catches fire and burns part of the kitchen, the Act applies to the physical damage and any injuries caused.
Defences under the Act are limited and must be strictly proved by the producer. They include compliance with mandatory regulations. If the defect results from compliance with a legal requirement that leaves no room for discretion, the producer is not liable. Development risks, sometimes called the state-of-the-art defence, where the state of scientific and technical knowledge at the time did not permit discovery of the defect, even using all available means. This is rarely successful because producers must show that no one in the field could have detected the risk. Defects in components. A producer of a finished product can argue that the defect lay entirely in a component supplied by another, provided they had no reasonable way to discover it. The component manufacturer, of course, may still be liable. Misuse or alteration by the consumer. If the damage is caused because the product was used in a way no reasonable person could have expected, or it was substantially modified after leaving the producer, liability may be excluded. For instance, using a toaster near water or tampering with internal wiring might break the chain of causation. Product not yet put into circulation. If the product was stolen from the factory or still under testing, the producer is not yet in the market for the purposes of the Act. A few illustrations show how this works in practice. Suppose a new brand of allergy medication causes serious side effects because the manufacturer failed to warn consumers that it should not be taken with another common medicine. Even if the drug met regulatory standards, the absence of an adequate warning could make it defective, and the manufacturer would be strictly liable under the Act. Or take a case involving a mobile phone battery that overheats and catches fire. The claimant doesn't need to prove any carelessness in the manufacturing process, only that the phone was defective and that defect caused their burns or property damage. Contrast that with a situation where the phone was damaged after the consumer used a cheap, unofficial charger that the manufacturer had clearly warned against. In that case, the misuse defense could succeed because the product was not being used in a way people were generally entitled to expect. Another example involves component parts. If an aircraft manufacturer fits an engine supplied by a specialist company and the engine later explodes due to an internal flaw, injuring passengers, the engine maker, not the aircraft assembler, is the liable producer. The assembler may rely on the components defense provided they had no reason to suspect the defect. Claims under the Act are subject to strict time limits. Proceedings must be brought within 3 years of the date the claimant became aware, or should have reasonably become aware, of the damage, the defect, and the identity of the producer. There is also a long stop limitation period of 10 years from the date the product was put into circulation. After 10 years, liability is extinguished, even if the defect only becomes apparent later, an important consideration for long-lasting goods like building materials or medical implants. In practice, claimants often bring actions in both negligence and under the Consumer Protection Act, covering all bases. The statutory claim is easier because it removes the need to prove fault, but sometimes negligence claims allow for broader categories of loss, such as warnings, recall duties, or contractual relationships. Solicitors advising clients must check which route offers the best prospects and what evidence exists. To sum up, the Consumer Protection Act 1987 creates a strict liability framework to protect consumers and ensure high safety standards across industries. It reflects the policy that those who profit from putting products on the market should bear the cost of injuries caused by defects rather than the injured consumer. The Act has proven effective in areas such as defective medical devices, contaminated food, exploding appliances, and hazardous chemicals. But it also has clear limits: no recovery for pure economic loss, limited defences, and tight time bars, making it essential for practitioners and SQE candidates to understand both its strengths and its boundaries.
Nuisance and the rule in Rylands and Fletcher. Let's turn to nuisance. Private nuisance protects the use and enjoyment of land. It's not about a single careless act, it's about ongoing or repeated interferences, or single events with continuing consequences that are unreasonable between neighbours. Ask, is there an interference with the claimant's use or enjoyment of land, or with a right over it? Does the claimant have a proprietary interest? Is the interference substantial, not trivial? Is it unreasonable by balancing all the circumstances: locality, duration, frequency, time of day, sensitivity of the claimant, social utility, and malice? Physical damage to land or buildings almost always counts. Loss of immunity, noise, odours, vibrations, fumes, dust depends on the character of the neighbourhood. Abnormal sensitivity is discounted. The ordinary occupier is the yardstick. Malice counts against the defendant. Remedies lean towards injunctions for ongoing nuisances, but courts are pragmatic. Sometimes damages in lieu are more appropriate if the public interest would be harmed by an injunction, or if an injunction would be oppressive. Defences include statutory authority, where the activity is authorised and the nuisance is its inevitable consequence, and prescription, where a nuisance has been enjoyed openly and as of right for 20 years. Coming to the nuisance is not a defence by itself, though it may influence locality and reasonableness. Public nuisance is different. It protects the public's comfort and convenience. Obstructing a highway, polluting a river, emitting noxious fumes across a wide area, it is both a tort and a crime. An individual claimant must show special damage beyond what the public at large suffers: personal injury, property damage, or pecuniary loss that is distinct and substantial. Otherwise, enforcement is for the Attorney General or public authorities. The modern statutory landscape now also includes a statutory public nuisance offence, but the private civil action continues where special damage is proved. Related but distinct is the rule in Rylands v. Fletcher. Think of it as a specialised, strict-ish liability for escapes from land. If you bring onto your land something likely to do mischief if it escapes, you keep it in at your peril. If it escapes and causes foreseeable damage, you are prima facie liable. Modern law has narrowed this. The use must be extraordinary or non-natural, not an ordinary domestic or municipal use. There must be an escape from the defendant's land, and the damage must be foreseeable of a type. Defences mirror nuisance, act of a stranger, act of God in rare cases, statutory authority, consent, only proprietary interests, consuno, and claims are about property interest, not personal injury. In practice, most modern disputes about escapes are resolved under negligence or nuisance, but the rule remains examinable and can be decisive on unusual facts. Before we leave land and products, let's revisit exclusion of liability and warnings. For occupiers, a clear, prominent warning can reduce or discharge the duty if in the circumstances it was reasonable to rely on a warning rather than to remove or guard against the danger. For visitors who are consumers, attempts to exclude liability for death or personal injury caused by negligence will be void. Attempts to restrict lesser liabilities will be tested for fairness and transparency. For non-visitors, warning signs and barriers matter because the duty is already narrow. A clear warning of an obvious natural hazard may be all that is reasonable.
7. Remedies. Now, remedies and how courts quantify damages across torts, we've already covered personal injury and fatal accident damages. But more generally, damages aim to put the claimant in the position they would have been in but for the tort, so far as money can. In nuisance, you may see injunctions tailored with precision, limited hours of operation, noise attenuators, dust suppression measures. You may see damages in lieu, where shutting down an activity would be disproportionate and money can fairly compensate. In product cases under the Consumer Protection Act, damages are compensatory for injury and qualifying property damage with standard personal injury principles applied. Recall that the Act does not provide a route for pure economic loss relating to the product itself. Illegality can sometimes bar a remedy entirely if the court concludes it would compromise the integrity of the legal system to award it. More often, practical defences like contributory negligence or valenti reduce or defeat recovery without invoking public policy at its highest pitch. Always remember mitigation. Claimants have a duty to take reasonable steps to limit their losses. They cannot sit back, let damages mount, and expect the defendant to pay for avoidable consequences. On the defendant's side, you should advise early on interim payments where liability is clear and the claimant's needs are pressing. This is both humane and consistent with your professional obligations. Let's bring back employers. Employers' primary liability is not the only way employees get compensated. Vicarious liability allows claimants to sue the employer for employees' torts committed in the course of employment. This is often decisive where an individual employee is uninsured or impecunious. In advising corporate clients, you need robust training, supervision, and incident reporting to reduce both primary and vicarious exposure. In advising claimants, always identify the deep pocket, the employer's insurer.
Areas of special difficulty. We should also speak briefly about product liability defences because they are exam favourites. Under the strict liability regime, the producer can avoid liability if the defect did not exist when they supplied the product, if the defect was due to compliance with mandatory regulations, if the state of scientific knowledge at the time could not have revealed the defect, or if the product was not placed into circulation in the relevant sense. Misuse and abnormal handling by the claimant can raise contributory negligence or defeat causation. In negligence, the ordinary defences apply, and causation can be the real battleground where the product is destroyed. Now, psychiatric harm again, this time from the standpoint of occupiers and public authorities. In occupiers' cases, secondary victim claims are scrutinised closely. Do not assume that witnessing an accident on land will be enough. The proximity requirements still apply. For public bodies managing natural spaces, policy arguments carry weight. The law does not expect rivers and lakes to be as safe as swimming pools, nor cliffs as safe as stairs. Clear warnings and obvious risks trim the duty back to what is reasonable in a free society. A word on ethics in practice. Your client might ask you to plead everything: negligence, nuisance, trespass, product liability, statutory breaches. Part of your duty is to exercise independent judgment. You must not mislead the court or waste resources. You should consider pre-action protocols, rehabilitation codes, ADR options, and the cost-benefit of injunctive relief. Explain to claimants the real purpose of damages, the risks of fundamental dishonesty allegations, and the importance of accurate disclosure of prior conditions and earnings. Explain to defendants the reputational and regulatory landscape, especially for public bodies and consumer brands. Causation in complex multi-defendant cases deserves a final pass, where several defendants each expose a claimant to a harmful agent, but science cannot say which exposure caused the indivisible disease. Liability can attach if each materially increased the risk. Where harm is divisible, like noise-induced hearing loss, courts can apportion causation and damages between defendants by period and intensity of exposure. Think practically. Apportionment is often about evidence and credible records. On the claimant's side, gather occupational histories, exposure matrices, and medical causation reports. On the defense side, scrutinize attributions and challenge leaps from correlation to causation. Let's return to pure economic loss with two typical illustrations because this is where candidates drop marks. First, a contractor negligently pours a weak concrete slab in a new house. Years later, it cracks. The cost of replacing the slab is a loss flowing from the defect itself. In tort, that is pure economic loss and usually irrecoverable. The proper route is contractual warranties, collateral warranties, statutory building regimes, or the Defective Premises Act, where applicable.
If the slab collapses and damages the claimant's furniture or injures someone, those consequential losses are recoverable in tort. Second, an accountant negligently certifies a company's accounts known to be used by a named investor to decide whether to purchase shares. The investor relies, buys, and loses money when the problems later surface. That is a negligent misstatement with assumed responsibility and reliance. Recovery for economic loss is possible. In both scenarios, the label economic loss is not the end of the analysis. You must ask which box it sits in and why. Before we close, let's assemble a mental checklist you can use in any tort problem. 1. Identify the tort or torts that fit the facts: negligence, occupiers liability, product liability, nuisance, Rylands, vicarious liability. 2. For negligence, walk the elements in order: duty, breach, factual causation, legal causation, remoteness, recognized heads of loss. 3. Spot special regimes, Occupiers Liability Acts, Consumer Protection Act, and apply their specific tests and defenses. 4. Scan for defenses: contribution, illegality, statutory authority, prescription, warnings, exclusion clauses. 5. Remedies: what realistically helps this client? Injunctive relief, damages, structured settlements, or rapid interim payments. 6. Ethics: advise with integrity, manage expectations, encourage early rehabilitation, and proportionate dispute resolution.
Practical examples for use when you practice. Think like this when a client calls. A dog walker trips over a raised paving slab at dusk and breaks an ankle. Duty? Yes. Breach. Was the defect significant, known or reasonably discoverable, and unremedied for long enough? Causation? Straightforward. Remoteness? Injury was foreseeable. Defenses: was the walker intoxicated? Did they ignore a clear barrier? Were they running in the dark without a torch? Remedy: pain, suffering, and loss of amenity, lost income, care, travel, treatment. Occupier or highway authority: check statutory inspection regimes and records. They may show reasonable systems. You can hear the whole analysis flow from the framework we've built. Or consider a warehouse neighbour suffering dust and noise from a new cement batching plant. Negligence? Possibly, but nuisance feels natural. Does the interference substantially and unreasonably affect use and enjoyment of land, given the locality? Are there mitigation measures the operator could implement at reasonable cost? Misting, acoustic barriers, restricted hours. Remedy might be an injunction tailored to performance standards, or damages if an injunction would be disproportionate. Public interest matters, but it is not a free pass to pollute a neighbourhood. Or a patient alleging delayed cancer diagnosis. Duty and standard: a reasonably competent specialist standard that withstands logical scrutiny. Causation: the but-for question can be hard. Did the delay cause a measurable reduction in survival chance or more aggressive treatment? You may need to argue material contribution to injury, where appropriate, and supported by expert evidence. Damages: pain, suffering, and loss of earnings, care and future treatment. Defences: diagnostics are rarely clear-cut. Logical defensibility of clinical judgment is key. Finally, remember the human element in psychiatric and fatal cases. Talk early about counselling, benefits, and support services. Build medical evidence carefully. Ensure witness statements explain proximity and perception for secondary victims. Be candid about control mechanisms and the likelihood of success. That is acting with integrity. You now have a full SQE-aligned tour of tort. Negligence, with all its core elements, remedies and defences, employers' primary duties and vicarious liability, occupiers' liability for visitors and trespassers, with warnings and exclusion, product liability in negligence and under the Consumer Protection Act, private and public nuisance with remedies and defences, and the specialised rule in Rylands v. Fletcher. If you keep returning to essentials, duty, breach, causation, remoteness, loss, defences and remedies, while staying alert to special regimes and ethical duties, you'll be able to analyse any tort scenario like a newly qualified solicitor. Thank you for watching, and if you enjoyed this video, give it a like so it spreads to more people. See you next time.
Did you know it's illegal in England to handle a salmon in suspicious circumstances? It's in the Salmon Act 1986.
And yet, this bizarre little statute sits in the same legal system that deals with constitutional principles, human rights, and judicial review. Welcome to the English legal system, where the same set of rules that define parliamentary sovereignty also worry about your behaviour around seafood. This lecture introduces you to the legal system for the FLK of the SQE. Think of this as a guided walk through the moving parts of law in England and Wales. By the end, you should be able to navigate the courts, explain why yesterday's cases matter today, read and act with confidence, handle rules of statutory interpretation, understand how Welsh and Westminster legislation coexist, and place constitutional principles, judicial review and human rights in their proper homes. We will also set the place of EU law in the UK Constitution post-Brexit. Dr. Yannis covers all the knowledge content the SRA determines is expected of a newly qualified solicitor.
The courts, the judiciary, court hierarchy, appeals, and rights of audience. Let's begin with the architecture of the English court system, the framework that keeps justice organised and decisions consistent across the country. At the foundation of criminal justice are the magistrates' courts. They deal with the smaller, summary offences, things like minor assaults or motoring cases, and they're also where almost every criminal case begins, no matter how serious it eventually turns out to be. Some offences, called either-way offences, can stay in the magistrates' court or move up, depending on how serious the facts are. The truly serious ones, the indictable-only offences, automatically go to the Crown Court, where a judge presides and, in most cases, a jury delivers the verdict. The Crown Court doesn't just try major criminal cases, it also handles sentencing and hears appeals from decisions made by magistrates. In civil justice, the starting point is usually the county court. That's where most private disputes begin, the sort of cases you might see about contracts, negligence, or property. But the bigger, more complex disputes, the ones needing specialist judges or involving points of law of wider importance, are heard in the High Court. The High Court has 3 historic divisions, each with its own character and expertise. The King's Bench Division hears contractual and tort claims, as well as applications for judicial review, the key mechanism for challenging public decisions. The Chancery Division looks after equity and trusts, company law and insolvency matters. The Family Division handles complex family disputes, guardianship and matters of wardship. Above the High Court sits the Court of Appeal, divided into a civil and a criminal division. Each deals with appeals from below, the civil division reviewing judgments from the High Court and County Court, and the criminal division hearing appeals from the Crown Court. Then at the very top of this judicial pyramid stands the Supreme Court, the final court of appeal for the United Kingdom in most matters. Created by the Constitutional Reform Act 2005 and operating since 2009, it replaced the Appellate Committee of the House of Lords, separating the highest judicial authority from the legislature to reinforce the independence of the judiciary. Running in parallel with the courts is the tribunal system, designed to handle specialist areas such as immigration, tax, social security, and regulatory disputes. It has its own structure, with the first-tier tribunal hearing cases initially and the upper tribunal handling appeals. From the upper tribunal, further appeals can go to the Court of Appeal, but only on points of law. And for certain rare matters, such as appeals from some Commonwealth countries or ecclesiastical courts, there's the Judicial Committee of the Privy Council, a vestige of the legal empire that still plays a role in specific jurisdictions.
Now, who are the people behind this structure, the ones who make the law work day to day? The judiciary. Judges in England and Wales are appointed on merit through the Judicial Appointments Commission, ensuring independence and fairness in the selection process. Once appointed, their independence is protected by security of tenure. They can't simply be dismissed because someone dislikes their decisions. Removal requires serious misconduct, and even then, the approval of Parliament. This safeguard means judges can focus on applying the law without political interference. Modern judges are also expected to reflect the society they serve, impartial, diverse and transparent in their reasoning while remaining insulated from external pressures. Judicial independence is not just an ideal, it's the foundation that maintains popular confidence in justice. Rights of audience, meaning who can speak in which court, are structured around this system. Traditionally, barristers appear in the higher courts, presenting arguments before judges and juries, while solicitors handle client work, preparation and advocacy in the lower courts. However, the line between them is less rigid today. Solicitor advocates can gain extended rights of audience, and chartered legal executives or other authorised professionals may appear where their regulator permits. Still, the old distinction continues to influence how legal work is divided, how cases are prepared, and the ethical responsibilities that follow.
Finally, let's look at appeals, the safety net of the justice system. Every case should have a route for correction, but appeals are not there to start everything over again. They're supervisory, designed to ensure that the law was correctly applied and that the process was fair. Appeals from the Magistrates' Court can go to the Crown Court for a full rehearing or to the High Court by way of case stated, that is, on a legal question. Appeals from the County Court or the High Court go to the Court of Appeal, usually on points of law or on mixed questions of fact and law, and only with permission. From there, cases may reach the Supreme Court, but only where a matter raises an issue of general public importance. At every stage, permission filters and standards of review act as checks. They preserve judicial hierarchy and prevent endless relitigation. The system's design ensures that justice remains both accessible and final, offering correction when necessary, but always mindful that the law must move forward, not in circles.
Development of case law and the doctrine of precedent. Now let's talk about the glue that holds the common law together, precedent. The English legal system is built on a principle known as stare decisis, which literally means to stand by things decided. What this means in practice is that lower courts must follow the legal principles, the ratio descendiendi, laid down by higher courts when the facts of the case are materially similar. These are the binding parts of a judgment, the core principles that must be applied again in future cases. Other remarks a judge might make, known as obiter dicta, can be persuasive and influential, but they don't have binding force. At the top of the pyramid, the Supreme Court has the power to depart from its own previous decisions when it is right to do so. This reflects a careful balance. The law must remain stable and predictable, but it must not become fossilized. The Court of Appeals, on the other hand, is generally bound by its own past decisions, that there are narrow exceptions. It can depart from its own authority to avoid internal contradictions, or where a higher court, like the Supreme Court, has changed the legal landscape. The High Court binds the lower courts, such as the county courts and magistrates, but not itself, and specialist tribunals are bound by higher judicial authority within their own jurisdictional area. Of course, the genius of the common law is that it can evolve while still respecting precedent. Courts create space to adapt through a process called distinguishing. This allows a judge to say that an earlier decision doesn't quite fit the case in front of them, because the facts, the context, or the legal framework are different in some meaningful way. It's a subtle craft, using similarity and difference to keep the law both coherent and responsive. And when a point of law truly needs to be revisited, the Supreme Court can overrule previous authority altogether. The real discipline for judges lies in maintaining the balance between respecting settled expectations and keeping the law in tune with modern statutory frameworks, human rights standards, and the realities of contemporary life. For practitioners, reading a case means doing several things at once: identifying the ratio, spotting the obiter, understanding which level of court made the decision, and then asking the crucial question, can my case be fitted within that line of authority, or can I legitimately distinguish it? That analytical habit is at the heart of legal reasoning in a common law system.
Primary legislation, the structure of an Act of Parliament and an Act of Senedd Cymru. Now let's turn to the spine of the legal system, primary legislation. An Act of Parliament is where law takes its most formal, written form. Each act follows a familiar architecture. It opens with a long title, a short title, and an enacting formula that declares Parliament's authority. Then come the sections, which contain the operative rules, and the schedules, which expand the detail. Many acts include interpretation sections that define key terms, commencement provisions that tell us when different parts come into force, and extent clauses that explain where the law applies across the United Kingdom's jurisdictions. Alongside most acts, Parliament publishes explanatory notes. These don't have legal force, they don't change the meaning of the statute, but they're invaluable guides to the background, context, and legislative purpose. They show what Parliament was trying to achieve.
Now, in Wales, legislation is made by the Senedd Cymru, and its acts, known as Acts of the Senedd, follow a similar pattern but with a different constitutional foundation. The Senedd can only legislate within its devolved competence, that is, on subjects that have been transferred from Westminster under the devolution settlement. So, while the structure of an Act of the Senedd looks familiar, the scope of its powers is defined by the constitutional framework that underpins devolution. One special feature of Welsh legislation is that it is bilingual. Every act is enacted in both Welsh and English, and both versions are equally authoritative. That means courts must read both texts together where any ambiguity arises, interpreting them in a way that preserves consistency with legislative purpose and constitutional competence. In practice, this creates a fascinating layer of interpretation. The law literally speaks two languages, and both must be heard in harmony.
Statutory interpretation, literal golden mischief, purposive, presumptions and aids, including Welsh legislation. And that brings us to one of the most intellectually rich parts of legal practice, statutory interpretation, the art of making sense of what Parliament actually meant. When text meets fact, interpretation begins. The literal rule asks what do the words mean in their ordinary, everyday sense. Courts start there because Parliament is presumed to say what it means, but the Golden Rule allows judges to depart from that plain meaning if following it would produce an absurd or inconsistent result, something Parliament clearly could not have intended. Then we have the Mischief Rule, which comes from a famous 16th century case called Hayden's case. Under this approach, the court looks back to the state of the law before the statute was passed and asks what mischief or problem was Parliament trying to remedy. The statute is then read in a way that suppresses that mischief and advances the remedy. Today, the dominant approach is the purposive approach, which asks what the statute was trying to achieve in its broader context. This is especially important in public law and human rights cases, where Section 3 of the Human Rights Act 1998 requires courts, so far as possible, to interpret legislation in a way that's compatible with convention rights. It's a vivid example of how interpretation and constitutional principle intertwine. Judges also use presumptions, default rules of interpretation, to guide them. They presume that Parliament does not intend to interfere with fundamental rights without clear and explicit words. Penal provisions are not stretched by implication. There is a presumption against retroactive effect, against ousting the jurisdiction of the courts, and in favour of compliance with international obligations. To uncover meaning, courts turn to aids to interpretation. Internal aids are those found within the statute itself, the long and short titles, section headings, punctuation, and the interpretation section. External aids are sources outside the statute, pre-legislative materials like white papers, law commission reports, and explanatory notes. And in limited cases, following the rule in Pepper v. Hart, judges may refer to statements made by ministers during parliamentary debates, but only to resolve genuine ambiguities or absurdities. For Welsh legislation, interpretation follows the Legislation Wales Act 2019, which sets out its own interpretive code. Because the text is bilingual, courts engage in what's called cross-reading, comparing both language versions to find the most coherent and faithful meaning. This bilingual dimension makes Welsh law a fascinating case study in how language shapes legal understanding.
The application of legislation made by Senedd Cymru and Westminster to England and to Wales. England and Wales operate within a single legal jurisdiction, one system of courts, one body of judges, one set of procedural rules. Yet devolution means that the substance of the law can now differ on either side of the border. What this means in practice is that two Acts of Parliament might sit side by side, one from Westminster and another from the Senedd Cymru in Cardiff Bay, each governing the same broad area but within its own sphere of authority. Most Acts of Parliament still extend to both England and Wales, but the detail often varies. Some provisions come into force at different times in Wales or contain specific carve-outs for devolved matters, areas where legislative power has been transferred to the Senedd. By contrast, Acts of the Senedd usually apply to Wales alone, though they can sometimes reach across the border where necessary. If, for instance, a Welsh law affects a cross-border public service, say health, education or environmental regulation, it may have limited effect in England, provided that the topic falls within the Senedd's legislative competence. So, how do you know which law applies? The practical skill lies in checking the extent clause of the statute. That section tells you where in the UK the law operates. Then you consult the Government of Wales Act 2006 as amended by the Wales Act 2017, which sets out the framework for devolution.
There you'll find the key division between what's reserved to Westminster, such as foreign affairs, defence or criminal law, and what's devolved to Wales, including health, education, housing and the environment. Within those devolved fields, Welsh ministers can make secondary legislation to give detailed effect to Senedd policies, statutory instruments that implement, adapt and update the law as needed. This layered structure means that two lawyers, one in Cardiff and one in London, might handle the same legal question under subtly different rules. For practitioners, the habit of mind is constant vigilance. Always ask which enactment applies, on what date, in which place, to which person or activity. These may sound like small details, but in a devolved system, they can change the entire outcome of the case.
Parliament, parliamentary sovereignty and the core institutions of the state. Let's now turn to constitutional law, the framework that defines how power is made, shared and kept in check within the United Kingdom. At its heart lies Parliament, the supreme lawmaking body. The orthodox doctrine of parliamentary sovereignty tells us that Parliament can make or unmake any law it chooses, and that no court, government or other institution can override or set aside an act of Parliament. That's the classic formulation. Elegant, absolute and uniquely British. But in practice, sovereignty today lives in a more complicated world. It coexists with other powerful constitutional forces, the rule of law, devolution, the Human Rights Act 1998, and, since Brexit, the ongoing status of retained and assimilated EU law. Sovereignty remains the cornerstone, but it stands within a network of constitutional relationships that constantly shape and restrain how it operates. When we talk about Parliament, we mean the combined authority of the House of Commons, the House of Lords and the monarch. Together they enact primary legislation, giving effect to the collective will of the state. In practice, the government, meaning the Prime Minister and Cabinet, controls most of the legislative timetable, introducing the majority of bills and steering them through the process. But it is Parliament that debates, amends and ultimately grants legitimacy through enactment. This process of scrutiny is more than formality. It's the mechanism through which democratic accountability meets the rule of law. At the centre of the constitutional machine sits central government, accountable in several directions at once. Ministers are answerable to Parliament through ministerial responsibility. They must explain and justify their actions to the House and resign when serious errors occur. Parliamentary questions, select committees and the Public Accounts Committee provide ongoing scrutiny, while the civil service implements policy on behalf of ministers operating under a duty of impartiality and political neutrality. Accountability in the UK Constitution is twofold. It is political, through Parliament's power to question, censure and ultimately remove a government, and it is legal, through the court's power to ensure that public authorities act within the limits of the law. This is where judicial review comes in, the mechanism by which judges supervise the exercise of public power. Judicial review doesn't challenge political decisions on their merits. It ensures that decisions are made lawfully, rationally and fairly. It is, in essence, the legal expression of the rule of law itself, an assurance that no one, not even the state, stands above the law.
The status of the devolved institutions and their relationship with Westminster. Devolution reshaped the constitutional landscape of the United Kingdom, transferring both lawmaking and executive powers to the Senate Cymru and the Welsh Government within what is known as a reserved powers model. Under this system, Westminster remains legally sovereign. It retains the ultimate authority to legislate on any matter. Yet in practice, sovereignty operates alongside political restraint. By long-standing constitutional convention, Westminster does not normally legislate in devolved areas without the consent of the Senate. That consent is given through what's called a legislative consent motion, a formal acknowledgement that the devolved legislature agrees to Westminster's intervention. The dividing line between what is reserved to Westminster and what is devolved to Wales is set out in the Wales Act 2017. It's a schedule that functions like a map of constitutional boundaries. Anything listed there remains under Westminster's control, and anything not listed falls within the Senate's competence, subject, of course, to certain constraints. Devolved powers must be exercised consistently with the European Convention on Human Rights, and within the framework of the single legal jurisdiction of England and Wales.
In practice, the boundary between devolved and reserved powers is not a wall, but a carefully negotiated frontier. Policy areas such as transport, agriculture, health, and the environment often overlap, and managing those overlaps requires constant dialogue between governments. Intergovernmental relations, common frameworks, and memoranda of understanding have developed to coordinate policies, share information, and prevent unnecessary conflict. These mechanisms help preserve the coherence of the United Kingdom, while still allowing each nation to experiment, adapt, and develop its own solutions. Devolution in that sense is both a test and a testament of constitutional flexibility, and a testament to the UK's capacity to accommodate diversity within unity. The monarch and the crown, constitutional conventions, and prerogative powers. In the modern British Constitution, the monarch reigns but does not rule. The Crown remains the legal foundation of government. It is the enduring legal personality through which executive power is exercised, but the day-to-day business of governing lies firmly in the hands of ministers who command the confidence of the House of Commons. This arrangement depends on a delicate web of constitutional conventions that keep the machinery of state running smoothly. The monarch acts on the advice of ministers, never on personal initiative. The Salisbury-Addison Convention restrains the House of Lords from blocking legislation promised in a government's election manifesto. The Sewell Convention restrains Westminster from legislating in devolved areas without the consent of the devolved legislature. None of these conventions are legally enforceable. You cannot go to court to compel obedience, yet they're politically binding, shaping conduct through shared constitutional expectation rather than legal compulsion. Then there are the royal prerogative powers, the historic remnants of the monarch's original authority that still form part of the executive toolkit. These include the making of treaties, the defence of the realm, the grant of honours, and the conduct of foreign affairs. Over time, many prerogatives have been limited, transferred, or replaced by statute, but those that survive do so only to the extent that Parliament has displaced them. Today, prerogative powers operate within a framework of accountability and legality. Ministers exercise them, not the monarch, and must answer to Parliament for their decisions. The courts, meanwhile, play a supervisory role. They do not question the merits of high policy, but they will ensure that prerogative powers are used lawfully and for proper purposes. And when prerogative power collides with statute, the rule is clear: statute prevails. What was once the personal power of the Crown has evolved into a carefully constrained instrument of responsible government, controlled by convention, accountable to Parliament, and subject to the rule of law.
Parliamentary privilege. Parliamentary privilege sits at the heart of the constitutional balance between Parliament and the courts. It exists to protect the independence of the legislature, to ensure that Parliament can carry out its work of debate, scrutiny, and lawmaking without interference from outside. The foundation of this privilege lies in Article 9 of the Bill of Rights 1689, which famously declares that proceedings in Parliament ought not to be impeached or questioned in any court. In plain terms, that means what happens inside Parliament, the debates, the votes, the speeches, cannot be challenged or examined by judges. This safeguard ensures that members can speak freely, criticise government, and debate controversial matters without fear of being sued or prosecuted for what they say. It is, in effect, a constitutional guarantee of free speech within the walls of Westminster. Privilege also covers what's called exclusive cognizance, Parliament's right to manage its own internal affairs without external interference. This includes the conduct of its members, the work of its select committees, and the rules governing its proceedings. Yet this autonomy is not unlimited. The modern understanding of privilege recognises that it extends only as far as is necessary to protect the core functions of Parliament, the freedom to legislate and to hold government to account. Where matters fall outside that core, the rule of law remains paramount. For practitioners, the message is clear. You cannot rely on statements made in Parliament to support a defamatory claim, nor can you bring litigation that seeks to challenge how a select committee conducted its business, except in the most exceptional and narrowly defined circumstances. The celebrated case of Pepper v. Hart does not undermine this principle. It simply allows courts in limited situations to refer to ministerial statements in Parliament to clarify ambiguous statutory wording. This does not mean questioning or criticising what was said. Rather, it treats those statements as interpretive aids, helping judges understand Parliament's intention without trespassing on its privilege. In short, parliamentary privilege protects the freedom of the legislature to speak, debate and decide, a living reminder that in the British Constitution, the independence of Parliament and the rule of law stand side by side, each reinforcing the other.
Legitimacy, separation of powers and the rule of law. The UK Constitution rests on three great pillars: democratic legitimacy, the separation of powers and the rule of law.
Together, they give authority to government and protection to the governed. Unlike a presidential constitution, the British model does not draw rigid boundaries between its branches of power. The legislator makes the law, the executive carries it into effect, and the judiciary interprets and applies it. Yet in practice, these functions often overlap. The executive proposes most bills that become acts of parliament. The Lord Chancellor still occupies a post that bridges politics and the judiciary. And judges, through the development of the common law, continue to shape legal principles that fill the gaps left by statute. But through all this interaction, one thing must remain constant: independence. Each branch must be free from improper influence by the others, particularly the judiciary, whose authority depends entirely on public confidence in its impartiality. Independence is the constitutional anchor that prevents power from drifting into abuse. At the core of this arrangement lies the rule of law, the idea that no power is absolute and that every exercise of authority must have a legal foundation. Public power must be used only for legitimate purposes, through fair procedures, and under the scrutiny of an effective review system. The rule of law also demands that the laws themselves meet certain standards. They must be general, clear, prospective, and publicly accessible. Only when citizens can know and understand the law can they be expected to obey it. And perhaps the most fundamental element of all, in the United Kingdom no one is above the law. Not ministers, not Parliament, not even the Crown. It is this shared submission to legality that gives the British Constitution both its authority and its moral strength. Making, implementing and repealing primary and secondary legislation at Westminster and in Wales. So how does a bill become an act? The journey from proposal to law is both procedural and political, a careful dance between scrutiny, debate and consent. A government bill usually begins in either the House of Commons or the House of Lords. Its first reading is a formality, the bill is introduced and ordered to be printed, but no debate takes place. The real work begins at the second reading, where the House debates the general principles and purpose of the bill. If it survives that stage, it moves to committee, where members go through the text line by line, proposing amendments and testing its detail. After the committee's work, the bill returns to the floor for the report stage, where further changes can be made, followed by the third reading, a final review before it leaves that house. The process is then repeated in the other house, which can amend the bill in turn. When the two houses disagree, the text is sent back and forth, a process often called ping-pong, until both agree on identical wording. Once the final version is settled, the bill receives royal assent, transforming it into an Act of Parliament. Even then, the law may not come into force immediately. Commencement can take effect straight away, on a specified date, or later by ministerial order, allowing flexibility in timing and implementation. Alongside acts sits a vast body of secondary legislation, also known as delegated legislation or statutory instruments. These are laws made by ministers or other authorities under powers granted by Parliament. Some statutory instruments require explicit parliamentary approval under the affirmative resolution procedure. Others take effect automatically unless annulled under the negative resolution procedure. This system allows Parliament to delegate technical detail to the executive while retaining ultimate control. In Wales, the process is much the same, but it takes place within the devolved framework. Senedd bills pass through similar stages of scrutiny, debate and amendment, and once enacted, become acts of the Senedd. Welsh ministers then make statutory instruments within devolved areas such as health, education and the environment, following procedures set by the Senate's standing orders and the governing legislation. Over time, laws evolve. They can be repealed or amended, either expressly, where a Parliament says so directly, or by implication, where a new law conflicts with an old one. Periodically, the statute book is tidied up through consolidation, gathering scattered provisions into a single coherent act. Full codification, bringing an entire area of law into one self-contained code, is rare in the common law tradition, but not impossible. It remains a kind of legislative ideal, order carved out of centuries of accreted complexity.
Public order law sits at one of the most delicate intersections in the legal system, the meeting point between individual freedom and collective safety. It seeks to protect the right to protest, to assemble and to speak out, while also safeguarding the public from serious disorder, intimidation or disruption. The law's constant task is to balance liberty with order. When a public procession is planned, a march, rally or demonstration, organisers must give prior notice to the police. This isn't designed to discourage protest, but to allow for policing arrangements that keep everyone safe. Once notified, the police have the power to impose conditions on a procession where it's necessary to prevent serious disorder, serious disruption, or intimidation. The same principle applies to static assemblies, gatherings in one place, where conditions may be imposed if the legal thresholds are met. In recent years, Parliament has refined and expanded these powers, responding to changing forms of protest. The law now defines serious disruption with greater precision and grants police new tools to manage tactics like locking on, gluing on, or tunnelling to block roads, transport networks, or critical infrastructure. Alongside these, civil orders, such as serious disruption prevention orders, target individuals with a history of causing repeated large-scale disruption. Yet through all these developments, one principle remains constant: proportionality. Any restriction on protest must go no further than is necessary to achieve a legitimate aim, whether that's public safety, the prevention of disorder, or the protection of the rights of others. Police decisions must be justified, recorded, and open to review. At common law, the concept of breach of the peace still survives. It allows preventative action, even without statutory authority where violence is actually occurring or is imminent. But modern policing and public order management rely increasingly on statute, with clearer powers, defined thresholds, and written reasons for action. For practitioners, the instinct should always be the same: test every restriction against the twin standards of necessity and proportionality, and look for clear statutory authority. The rule of law demands no less. Protest is a right, but a right exercised within the limits of lawful order.
Judicial review: nature, process, limits, and remedies. Judicial review is the constitutional mechanism through which the High Court supervises the exercise of public power. It is not about whether a decision was wise or fair in the everyday sense, but whether it was lawful, whether the decision-maker had the power to act, stayed within that power, followed fair procedures, and reached a decision that was rational on the evidence before them. Judicial review ensures that government acts according to law, not whim. At its core, the court asks a series of disciplined questions. Did the authority have the legal power to act? Was that power used for its proper purpose? Were relevant factors considered and irrelevant ones ignored? Was the process procedurally fair? And was the decision one that a reasonable decision-maker could have reached? Not necessarily the best decision, but one within the lawful bounds of reason. Judicial review is not an appeal on the merits. The court does not substitute its own judgment for that of the public authority. Its task is to police legality, not policy. A claim for judicial review must be brought promptly and in any event within 3 months of the decision under challenge. Certain areas, such as planning or public procurement, have even shorter time limits. The requirement of standing or locus standi means the claimant must have a sufficient interest in the matter. This is interpreted generously where issues of public importance arise. Community groups, campaigners, and NGOs can have standing if the rule of law itself is at stake. What matters is not the label attached to the body being challenged, but the nature of the function it performs. Public law obligations follow the function, not the form. So a private company carrying out public functions, for instance, managing prisons, housing, or health services under contract, may still be amenable to judicial review. The remedies available are deliberately flexible, allowing the court to tailor its response to the circumstances. The court may issue a quashing order, setting aside the unlawful decision, a prohibiting order, preventing future unlawful action, or a mandatory order, compelling the performance of a public duty. It can make a declaration to clarify the law and guide future conduct, or an injunction to restrain continuing illegality. Damages are exceptional in judicial review. They are awarded only if another cause of action, such as a breach of statutory duty or a claim under the Human Rights Act 1998, provides a route to compensation. Recent reforms have introduced suspended and prospectively only quashing orders, giving courts discretion to delay or limit the effect of nullifying an unlawful act, where immediate cancellation would cause disproportionate disruption. But the default principle remains the same. An unlawful act is voidable, and unless there is good reason not to, it will be set aside. Judicial review, then, is not a weapon of politics, but a safeguard of principle, the rule of law in action. ensuring that those who wield public power do so within the limits that law, reason, and fairness demand.
Grounds of review: illegality, irrationality, procedural impropriety, and legitimate expectation. The grounds of judicial review define the limits of lawful public decision-making. They are not rigid categories, but flexible principles that guide how courts assess whether power has been exercised properly. 4 of the most significant are illegality, irrationality, procedural impropriety, and legitimate expectation. Illegality occurs when a public authority steps outside the powers that Parliament intended it to have. A decision-maker acts unlawfully if they use a power for a purpose other than that for which it was conferred, if they misdirect themselves in law, or if they fetter their discretion by adopting an inflexible policy that refuses to consider exceptions. Public bodies must always be open to the particular facts of each case. Delegated powers are not personal gifts. They are held in trust for the public to be exercised only within the boundaries set by statute and principle. Irrationality, sometimes called Wednesbury on reasonableness, captures decisions so unreasonable that no reasonable authority, properly directing itself, could ever have made them. This is an exacting standard, not a license for courts to second-guess administrative choices. However, the intensity of review varies with context. Decisions affecting fundamental rights or vital interests attract closer scrutiny, while those involving complex policy, national security, or economic judgment are reviewed with restraint. The guiding idea is proportionality between the importance of the issue and the depth of judicial intervention. Procedural impropriety focuses on fairness in the process rather than the outcome. It includes failures to follow mandatory statutory procedures, breaches of natural justice such as bias or the appearance of bias, and the denial of a fair hearing where fairness requires one. The hallmark of good administration is not just that decisions are lawful, but that they are made transparently, impartially, and with an open mind. Finally, legitimate expectation bridges procedure and substance. It arises when a public authority, through an express promise, a consistent past practice, or a published policy, creates a reasonable expectation that it will act in a particular way, perhaps by consulting before changing policy, giving reasons before taking action, or even delivering a specific benefit or outcome. Where such an expectation exists, fairness may require the authority to honour it unless an overriding public interest justifies a change of course. The doctrine protects trust between citizen and state. Government may change its mind, but it must do so fairly, with candour and justification. Together, these grounds form a singy principle in action that public power is never absolute. It must be exercised for lawful purposes, in a rational way, through fair procedures, and in good faith towards those it affects.
Decisions that may be challenged and the scope of the supervisory jurisdiction. Judicial review reaches across the full landscape of public administration. Anybody exercising public power, whether central or local, statutory or delegated, may find its decisions tested against the standards of legality, rationality, and fairness. The range is broad. Decisions by central government departments, local authorities, regulators, police forces, NHS trusts, school governors, prison authorities, and a host of other public bodies are all amenable to judicial review. What matters is not the label attached to the body, but the nature of the function it performs. If a private organisation is carrying out a task that is essentially public, for example, managing detention centres, running social housing, or delivering healthcare under government contract, its decisions may equally be subject to the court's supervisory jurisdiction. Public law follows function, not form. Even so, courts exercise restraint. They recognise that some areas, high policy, foreign affairs and national security, for instance, lie close to the heart of the political process, where ministers must answer primarily to Parliament, not the judiciary. Yet even there, the rule of law has reach. Judges will still ensure that decisions are lawful, rational and procedurally fair, even if they avoid pronouncing on the wisdom or expediency of policy itself. When governments seek to insulate decisions from review through ouster clauses, statutory provisions that attempt to exclude the jurisdiction of the courts, the judiciary reads them with great care. Only the clearest words can exclude judicial supervision, and even then, only within constitutional limits. The courts have made plain that total exclusion of judicial review would undermine the very rule of law on which Parliament's authority itself depends.
There are times, however, when Parliament deliberately creates a specialist appellate route within a statutory scheme, for instance, to challenge planning, immigration, or regulatory decisions. Where such an alternative mechanism exists, claimants will usually be expected to use it rather than resort to judicial review. The High Court will step in only where the issue is of jurisdiction, meaning that the decision-maker acted wholly outside its powers, or where the statutory process cannot cure a fundamental unfairness. In short, judicial review is both wide and disciplined. It reaches wherever public power is exercised, but it does so with respect for constitutional boundaries, ensuring that the courts remain guardians of legality without straying into the territory of governance itself.
Standing and time limits. To bring a claim for judicial review, a claimant must cross two key thresholds, standing and timing. These are not mere procedural details. They reflect the balance between access to justice and the need for certainty in public administration. The requirement of standing means that the claimant must have a sufficient interest in the matter. Judicial review is not confined to those with a personal injury or private grievance. It is about the lawfulness of public action, not the vindication of private rights. This means that public law charities, campaign groups, and NGOs can have standing, where their focus is on ensuring that government acts within the law. The courts have recognized that the rule of law sometimes needs guardians beyond those directly affected. That said, standing is not unlimited. Judicial review is not a stage for purely academic challenges or abstract disputes. The court will ask whether there is a real practical stake in the outcome, and whether the issue is justiciable, that is, suitable for resolution by legal principles rather than political debate. The claimant must show that the question raised is both concrete and properly within the court's remit. Timing is equally strict. Claims must be brought promptly and in any event within 3 months of the decision being challenged. This reflects the need for good administration and certainty. Public authorities and third parties must be able to rely on decisions once made. Courts will grant extensions of time only sparingly, and they weigh any prejudice to good administration very heavily. The longer a claimant delays, the harder it becomes to justify intervention. Certain areas have even tighter rules. Planning decisions and public procurement challenges have their own bespoke, shorter deadlines, often measured in weeks rather than months. And where Parliament has created a statutory appeal process for a particular kind of decision, that route will usually take precedence, leaving judicial review as a remedy of last resort. Standing and timing, then, are the gatekeepers of judicial review, ensuring that challenges are brought by those with a genuine interest at the right time and in the right way, so that the courts can protect legality without paralyzing the machinery of government.
The Human Rights Act 1998 and the European Convention on Human Rights. The Human Rights Act 1998 transformed the landscape of public law by weaving the rights of the European Convention on Human Rights directly into the fabric of UK law. Before the Act, those alleging a breach of their convention rights had to take their case to Strasbourg. Now, the same rights can be argued and enforced before domestic courts in England and Wales, Scotland and Northern Ireland, a profound constitutional shift that made human rights an everyday part of British legal reasoning. When a court is asked to decide a question involving a convention right, it must take into account the jurisprudence of the European Court of Human Rights. This does not mean blind obedience. UK courts treat Strasbourg decisions with respect, not reverence. They aim to follow the general principles laid down by the European Court, while retaining the autonomy to apply them within the distinctive framework of domestic law and the constitutional traditions of the United Kingdom. Section 3 of the Act gives judges a powerful interpretative tool. Legislation must, so far as possible, be read and given effect in a way compatible with convention rights. This duty applies to all courts and tribunals and extends across all primary and secondary legislation. Where such a reading simply cannot be achieved, where words cannot be bent without breaking the meaning of the statute, the higher courts may issue a declaration of incompatibility. A declaration does not strike down the statutes. The doctrine of parliamentary sovereignty remains intact. Instead, the declaration signals to Parliament that the law as enacted sits uneasily with the UK's human rights obligations and invites legislative correction. This careful balance between judicial scrutiny and parliamentary supremacy reflects the Act's constitutional subtlety. The courts illuminate, but Parliament decides. Public authorities, for their part, are under a positive duty to act compatibly with convention rights unless compelled otherwise by primary legislation that leaves no room for compliance. This duty extends beyond central government and local councils to include the police, NHS bodies, schools, prisons, and even private organisations performing public functions. An individual who claims to be a victim of an unlawful act by a public authority can bring proceedings under the Act or rely on their convention rights in any other legal proceedings. The courts may grant whatever remedy is just and appropriate, including damages where necessary to afford just satisfaction, though damages remain the exception rather than the rule. Where incompatibility is formally declared, remedial orders provide a streamlined way for Parliament to amend the offending legislation. Schedule 1 to the Act sets out the rights themselves: the right to life, the prohibition of torture and inhuman or degrading treatment, the right to liberty and security, the right to a fair trial, respect for private and family life, freedom of thought, conscience and religion, freedom of expression, assembly and association, protection of property and the right to education, among others. These rights, once distant and international, now speak directly within domestic law. For the practitioner, the habit must be to think Human Rights Act early. Ask, is there a public authority involved? Which right is engaged? Has there been an interference? And if so, is it prescribed by law, pursuing a legitimate aim, and necessary in a democratic society? And finally, what remedy is realistically available and proportionate? The Human Rights Act does not replace the common law or the Constitution, it enriches both, infusing legal reasoning with principles of dignity, fairness and proportionality. It ensures that government, however powerful, remains answerable to the individual whose rights it affects.
The place of EU law in the UK Constitution after Brexit. Although the United Kingdom has left the European Union, the influence of EU law continues to ripple through almost every area of legal practice. Brexit did not wipe the slate clean, it froze and reshaped it. Through the European Union Withdrawal Acts 2018, Parliament ensured that at the end of the transition period, a vast body of law known as retained EU law was carried forward into domestic law. This body preserved the effect of EU regulations, directives implemented through UK legislation, and related case law as they stood on exit day, so that legal continuity would not collapse overnight. This retained law was not static. Subsequent reforms have refined and rebranded it, giving rise to the term assimilated law, a category that reflects both continuity and adaptation. The aim was to domesticate what had been EU law, removing its supranational character and reasserting the authority of UK institutions to amend, interpret and develop it going forward. Assimilated law remains rooted in its EU origins, but its constitutional footing has shifted. It is now UK law, subject to UK principles of interpretation and modification. Before Brexit, the supremacy of EU law meant that, in case of conflict, directly effective EU provisions took precedence over inconsistent domestic statutes. That principle no longer applies to new legislation made after the UK's departure. While supremacy still governs the interpretation of pre-exit conflicts to preserve legal certainty, it no longer operates prospectively. From 2021 onwards, Parliament's sovereignty is restored in full, and new Acts of Parliament take unquestioned precedence within the domestic hierarchy. Equally, UK courts no longer make references to the Court of Justice of the European Union. Questions of EU law interpretation now rest entirely with the domestic judiciary. However, the Withdrawal Act preserved the body of pre-Brexit CJEU case law, making it binding on most courts unless and until departed from by higher authority. The Supreme Court and the Court of Appeal now have express power to depart from retained EU case law where they consider it right to do so, balancing the need for legal stability with the freedom to evolve beyond the EU framework.
Central government accountability, ministerial powers and prerogative in practice. Accountability in the British Constitution works like a series of concentric circles, each one enclosing the next. At the centre stand the ministers of the Crown, accountable in three distinct ways. They are politically accountable to Parliament, legally accountable to the courts, and ethically accountable to established codes of conduct. These overlapping forms of scrutiny ensure that power, though centralised, is never absolute. In the political sphere, ministers must answer to Parliament through questions, debates, select committee inquiries, and ultimately the confidence of the House of Commons. Political accountability does not depend on legal wrongdoing. It is about transparency, responsibility, and the maintenance of trust in democratic government. Legal accountability operates through judicial oversight. The courts can examine whether ministers and public bodies have acted within the powers conferred by law, the principle of ultra vires, or acting beyond legal authority. This extends to secondary legislation, which may be challenged for exceeding the scope of the parent act, for procedural defects in its making, or for unreasonableness in substance. The same principles apply to prerogative powers, such as those concerning foreign affairs, passports, or national security. Where such powers are justiciable, courts can review them on familiar public law grounds: legality, rationality, procedural propriety, and respectful legitimate expectation. Parliament may also choose to curtail or replace prerogative powers by statute, reinforcing the supremacy of law over executive discretion. Beneath a ministerial level, the civil service operates under its own code, requiring impartiality, integrity, objectivity, and honesty. Every public body, from regulators to local councils to schools, prisons, and NHS trusts, must act within the limits of its founding statute, guided by the overarching principles of public law. For practitioners advising public authorities, the golden rule is prevention before litigation. That means ensuring fair consultation where fairness demands it, publishing clear and consistent policies, taking relevant matters into account, avoiding irrelevant ones, giving intelligible reasons for decisions, and keeping a defensible record of the decision-making process. A well-documented and proportionate approach is the best protection against successful challenge. For those advising claimants, accountability has its own tactical logic. The key is to choose wisely the right defendant, the right round of challenge, and the right remedy, and to act quickly within the time limits that judicial review imposes. In both public administration and litigation, accountability is not merely a control mechanism, but a discipline, one that builds lawful, transparent, and reasoned governance, and reinforces public confidence that those who wield power remain answerable to the law.
Parliamentary procedure, delegated powers and scrutiny in Westminster and the Senate. The quality of legislation depends less on the words on the page than on the process that produces them. Sound legislative process is the foundation of legal certainty and public confidence. When Parliament delegates lawmaking powers to ministers, those powers must be specific, proportionate, and subject to proper scrutiny. Broad skeleton clauses, which leave the substance of regulation to be filled in later, risk undermining accountability. They invite both political criticism and legal challenge on grounds of vagueness or excessive delegation. Different forms of parliamentary procedure reflect different levels of scrutiny. Under the affirmative procedure, an instrument must be expressly approved by Parliament before it can take effect, ensuring debate and visibility. The negative procedure, by contrast, allows an instrument to become law automatically unless Parliament actively prays to annul it within a defined period, so its effectiveness depends on vigilance from backbenchers and committees. The super-affirmative procedure, used rarely for matters of high significance, goes further by requiring draft consultation and pre-enactment scrutiny before the regulation is made. In Wales, the Senate follows similar scrutiny routes, adapted to its devolved context. Because Welsh legislation governs key aspects of daily life, education, health, housing, the environment, the clarity of explanatory material and the precision of bilingual drafting are of exceptional importance. Lawyers must treat the English and Welsh texts as equally authoritative, reading both where meaning diverges and aligning interpretation with legislative purpose. For the practitioner, the discipline is always to read in layers. First, the empowering act, then the procedure used to make the delegated legislation, and finally the instrument itself, paying close attention to commencement dates, territorial extent, and any transitional arrangements that determine how and when the rules bite. Judicial review sits alongside this structure as the system's supervisory safeguard, not an appeal on the merits. Courts do not substitute their own policy preferences for those of elected or expert decision-makers, particularly where statutes entrust matters of technical complexity or resource allocation to specialized bodies. Yet the courts ensure that all decision-makers remain within the legal boundaries of their powers, act fairly and rationally, and respect fundamental rights. The intensity of review varies with the subject matter. Where human rights or liberty are engaged, proportionality demands closer scrutiny. Where Parliament has allocated scarce resources, rationality review is more restrained.
Remedies in judicial review remain discretionary and attuned to good administration. Increasingly, courts make use of suspended or prospective-only quashing orders, allowing public bodies to correct legal defects without destabilizing complex regulatory schemes or invalidating decisions retroactively. This reflects a modern, pragmatic balance between legality and continuity. Beyond formal law, constitutional conventions provide the soft tissue around the constitutional skeleton. They describe how public actors behave when the black-letter law is silent or too blunt. Conventions operate on trust and shared understanding. The monarch acts on ministerial advice, ministers resign for departmental failures, and Westminster seeks devolved consent before legislating on devolved matters. Breaching a convention carries no legal penalty, but the political cost can be immense, and persistent breach corrodes the working constitution itself. For lawyers, conventions matter because they shape both the ethics of governance and the expectations of stability on which markets, institutions, and communities depend. When advising government, one must ask not only can we do it, but also should we do it and what will happen if we do. When advising clients affected by regulation, an awareness of convention underpins confidence in the predictability of public action. These principles converge vividly in modern protest law, where questions of human rights, public order, and administrative discretion collide. Imagine a protest group planning a disruptive march. The police, invoking their statutory powers, impose conditions to prevent serious disruption. The organizers claim a breach of their freedoms of expression and assembly under the Human Rights Act. The court's task is to apply the familiar proportionality test. Is the restriction prescribed by law? Does it pursue legitimate aims, such as public safety or the protection of others' rights? And is it necessary and proportionate in the circumstances? That analysis folded naturally into the public law framework. Did the police consider all relevant factors, apply the statutory tests correctly, act within their powers, and provide reasons capable of withstanding scrutiny? The remedy might be a declaration, the quashing of particular conditions, or an urgent interim order to pause enforcement until the lawfulness of the restriction can be determined. Here, the abstractions of the constitutional theory meet the immediacy of real life, where protest, power, and principle collide in the streets, and the courts mediate between liberty and order in the language of legality and reason.
Conclusion. The legal system of England and Wales is at once continuous and dynamic. It honours precedent but adapts by distinguishing and by overruling where necessary. It respects parliamentary sovereignty but commits to the rule of law and human rights. It speaks with a single jurisdictional voice, even as it allows Wales to legislate distinctly within devolved competence. It has stepped out of the EU while carrying forward a large body of EU-derived rules as domestic law. It empowers protest while protecting order. It keeps public authorities within the law without substituting judicial preferences for democratic choices. For SQE practice, your craft is to move easily among these layers. Read acts fluently, interpret purposefully, argue precedent honestly, and deploy judicial review with precision and restraint. Do that and you will be the kind of newly qualified solicitor this system expects. Practical, principled, and effective. I hope you don't smell of fish after an hour of watching Fishmongers. Thank you for watching, and have a look around Dr. Yannis' channel for more.
Office romance is usually just frowned upon. But in the world of legal services, that same romance can cost you your entire livelihood.
A partner at a major international law firm had a consensual intimate encounter with a junior colleague. It happened after work, in private, with no clients, no legal files, no courtroom in sight. Yet the Solicitors Regulation Authority decided that this private moment was their business. They sanctioned him for failing to act with integrity and for damaging public trust in the profession. His personal life became a regulatory case. His relationship choices became evidence.
His reputation and his career hung in the balance. The case went all the way to the courts, which eventually pushed back, saying the SRA had overreached, but the warning shot was unmistakable. When you become a solicitor, your professional obligations do not clock out at 5 p.m. In this profession, the border between your working life and your private life isn't a line, it's a tripwire. And that is why the SQE puts such a heavy emphasis on ethics, because in legal services, who you are outside the office can be just as dangerous as what you do inside it. Welcome to this lecture on the regulation of legal services in England and Wales. This material forms the structural bedrock on which all substantive legal practice rests. For candidates preparing for the solicitor's qualifying examination, particularly the FLK1 assessment, the topic of legal services often feels meta, because it governs the very existence, behaviour and business models of the solicitor's profession. It is not simply an irritating layer of bureaucracy sitting on top of real law. It is a dynamic, high-stakes environment in which statutory obligations, ethical duties and commercial realities intersect constantly in day-to-day practice. As of late 2025, this landscape has tightened markedly, shaped by reforms such as the Economic Crime and Corporate Transparency Act 2023, enhanced money laundering supervision, and a sharper enforcement stance from the Solicitors Regulation Authority. What follows is a comprehensive, integrated narrative of that framework designed to match the SRA specification for FLK1. It traces the tiered regulatory structure created by the Legal Services Act 2007. It explains how the principles and the Statement of Solicitor Competence frame everything a solicitor does, explores the pervasive reach of anti-money laundering regimes, examines the interaction between legal practice and financial services regulation, and unpacks the economics of funding legal work. Along the way, it highlights important developments from 2024 and 2025, such as the delay to the legal aid means test review, the commencement of the corporate offence of failure to prevent fraud, and key judicial decisions on damages-based agreements and litigation funding.
The regulatory role of the SRA. The starting point for understanding the regulatory architecture is the Legal Services Act 2007 and the reforms associated with the Clementi Review. Under the old system, the Law Society effectively played a dual role, both as representative body for solicitors and as regulator. The Clementi reforms concluded that this model risked prioritizing the interests of the profession over those of the public. The Legal Services Act therefore created an institutional hierarchy that separates oversight, regulation, and representation. At the top sits the Legal Services Board, an independent oversight body with statutory objectives such as protecting and promoting the public interest, improving access to justice, promoting competition in legal services, and encouraging an independent, strong, and effective legal profession. The Legal Services Board supervises approved frontline regulators, but does not regulate individual solicitors directly. That task falls primarily to the Solicitors Regulation Authority. Legally, the SRA is an arm of the Law Society, but it operates with substantial operational independence. It regulates over 100,000 solicitors and thousands of firms in England and Wales. The Law Society, stripped of its regulatory functions, now operates as a representative body. It lobbies, advises, and supports the profession. For SQE purposes, it is essential to keep this distinction clear. The SRA sets and enforces standards. The Law Society represents solicitors. When you are asked in an exam scenario which body investigates misconduct or issues practicing conditions, the answer is the SRA, not the Law Society.
Principles and risk-based regulation. The SRA regulates on two levels, at At the high level stand the SRE principles, which function as the ethical constitution of the profession. Below them sit the detailed codes of conduct, one for solicitors and one for firms. The SRA makes it clear that the principles are fundamental tenets of ethical behavior and are mandatory. They apply to authorized persons and firms at all times, and they apply even outside purely professional contexts. If a solicitor's private conduct undermines public trust or breaches the principles, regulatory action can still follow. Where there is a conflict between a principle and some other provision in the rules, the principle prevails. As of 2025, the SRA principles can be understood as 7 core duties. First, a solicitor must act in a way that upholds the constitutional principle of the rule of law and the proper administration of justice. This is the paramount obligation. If a client's instructions would require the solicitor to mislead the court, to suppress evidence that must be disclosed, or otherwise to interfere with the administration of justice, the duty to the court overrides the duty to the client. The solicitor serves the court and the legal system first, and the client second. Second, a solicitor must act in a way that upholds public trust and confidence in the profession and in the provision of legal services generally. This principle reaches into the solicitor's private life. Disciplinary tribunals have repeatedly sanctioned solicitors for matters such as dishonesty in personal financial dealings, criminal convictions for drink driving or assault, and abusive behavior on social media on the basis that such conduct damages public trust in the profession. Third, a solicitor must act with independence. Professional judgment must not be compromised by the interests of third parties, funders, employers, or powerful clients. This is particularly important in contexts such as referral arrangements, managed litigation, or group actions, where commercial pressures may push a solicitor towards a course of action that suits a referrer or funder, but is not in the client's best interests. The solicitor must resist those pressures. Fourth, a solicitor must act with honesty. Honesty is treated as an absolute. Where a tribunal makes a finding that a solicitor was dishonest, meaning they subjectively knew that what they were saying or doing was false, and their conduct would be considered dishonest by the standards of ordinary decent people, the usual outcome is removal from the role. Honest mistakes can be remedied. Dishonesty is treated as fundamentally incompatible with continued practice, save in the most exceptional circumstances. Fifth, a solicitor must act with integrity. Integrity is a broader and more nuanced concept than honesty. A solicitor may avoid outright lying and yet still fail to act with integrity. For example, allowing the court or an opponent to labour under a serious misconception that benefits the client, exploitatively taking advantage of an obvious clerical error in a way that is manifestly unfair, or drafting documentation that deliberately obscures critical risks, can all be treated as a lack of integrity even if no blatant falsehood is spoken. Sixth, a solicitor must act in a way that encourages equality, diversity, and inclusion. This has moved beyond a passive duty not to discriminate into a proactive obligation to foster inclusive workplaces and client environments. It dovetails with the Equality Act 2010, which prohibits discrimination, harassment, and victimization on grounds such as race, sex, disability, religion or belief, and other protected characteristics. If a firm fails to address harassment, tolerates discriminatory practices in recruitment or promotion, or operates in a way that consistently disadvantages particular groups of clients, that is not merely a civil risk, it is a regulatory breach of this principle as well.
Seventh, a solicitor must act in the best interests of each client. This underpins the entire solicitor-client relationship, but it is meaningful that it appears after the other principles. The ordering is symbolic. Acting in the client's best interests never justifies breaking the law, misleading the court, acting without integrity, or undermining equality and inclusion. The client's interests are extremely important, but they are not absolute. Alongside the principles, the Statement of Solicitor Competence defines the standard of safe practice. Qualification through the SQE is an entry point, not the end of learning. The Statement of Solicitor Competence requires solicitors to maintain their knowledge and skills, to identify the limits of their competence, to obtain appropriate supervision, and to resist pressure to act beyond their expertise or in breach of ethical norms. For an SQE candidate, the Statement of Solicitor Competence is the reference point for what a competent, newly qualified solicitor should do in scenario-based questions.
If a hypothetical solicitor with no tax expertise accepts a complex corporate tax instruction without seeking specialist assistance, that is not just a bad career move, it is a regulatory problem because the solicitor is acting outside their competence and risking serious harm to the client. The SRA's approach to enforcement is explicitly risk-based. It recognizes that it cannot investigate every minor lapse, so it concentrates resources on the areas where risks to the public and the rule of law are greatest. These include misuse of client money, failings in anti-money laundering systems, poor treatment of vulnerable consumers, and behavior that undermines trust in the profession. In recent years, and especially following the Economic Crime and Corporate Transparency Act 2023, the SRA's enforcement toolkit has been strengthened. One of these striking changes is that the statutory cap on financial penalties for economic crime-related breaches has been removed. Where previously fines for traditional firms were generally capped at a relatively modest level, the SRA can now impose unlimited financial penalties for serious failings linked to money laundering, sanctions breaches, and related misconduct. This sends a clear message that the profession is expected to play a robust gatekeeping role and that deliberate or reckless facilitation of economic crime will not be treated as a minor regulatory hiccup. In parallel, the SRA has refined its supervision and audit processes. In the accounts rules context, the 2025 focus has fallen on two practical indicators: 5 weekly kind account reconciliations and the handling of residual balances. Rule 8.3 requires reconciliations at least every 5 weeks, and the SRA now treats these as fixed milestones rather than vague expectations. Persistent lateness, superficial review, or a failure to act on reconciliation discrepancies can trigger deeper regulatory scrutiny, because they may indicate broader weaknesses in governance and financial stability. Residual balances, small sums left lingering on client accounts at the end of a matter, are also a concern. Firms are expected to return client money promptly once there is no continuing reason to hold it. Using client accounts as quasi-banking facilities, or simply failing to clear old balances for years, is seen as unacceptable.
Reserved legal activities. To understand how far the solicitor's monopoly extends, it is necessary to turn to the concept of reserved legal activities under the Legal Services Act 2007. The word lawyer is not protected, and in many areas anyone can offer legal advice. An unregulated advisor can explain unfair dismissal law, draft the basic contract, or even prepare a will. However, to protect the public in particularly sensitive areas, Section 12 and Schedule 2 of the Act create 6 categories of reserved legal activity. Performing these without authorization or holding oneself out as authorized to do so when one is not is a criminal offense. The 6 reserved activities can be described in narrative form. The first is the exercise of a right of audience. This means the right to appear before a court as an advocate, to address the judge, and to examine or cross-examine witnesses. Solicitors who have qualified for rights of audience in the criminal and civil higher courts may appear in those courts. Solicitors and certain other authorized persons have rights of audience in the lower courts as part of their general authorization. The second reserved activity is the conduct of litigation. This includes issuing proceedings, commencing, prosecuting and defending claims, and handling the formal procedural steps such as filing documents and managing correspondence on the court record. Advising a client about whether to sue or settle is not itself reserved, but formally running the litigation is. The third reserved activity is the category known as reserved instrument activities. This is essentially the technical heart of conveyancing. It covers preparing instruments of transfer or charge in relation to registered land under the Land Registration Act 2002 and certain related land registration functions. The fourth reserved activity relates to probate. It is not will writing as such, but the preparation of probate papers for the purpose of the law of England and Wales or for proceedings for a grant of representation. The fifth reserved activity comprises notarial services. Notaries who are regulated separately authenticate and certify documents for use abroad, among other functions. Finally, the administration of oaths is a reserved activity. Swearing affidavits and statutory declarations and taking certain formal oaths may only be carried out by authorized persons, such as solicitors with the relevant status or commissioners for oaths.
The way these reserved activities interact with unregulated work creates a complex market. Unregulated providers can carry out substantial volumes of legal work as long as they avoid reserved activities and do not mislead the public about their status. At the same time, law firms may unbundle services, allowing clients to handle some aspects of a case themselves, while the firm retains responsibility for the portions that involve reserved work. This unbundling can improve access to justice, but creates regulatory risk. If an unadmitted paralegal effectively runs a litigation file with minimal supervision, that may amount in substance to the conduct of litigation by an unauthorized person. If an unregulated advisor appears in court in circumstances where reserved rights of audience are required, the criminal provisions of the Legal Services Act may be engaged. In exam scenarios, it is important to be alert to the offence of holding out. Even if someone does not actually carry out a reserved legal activity, they commit an offence if they hold themselves out as entitled to do so, or as being a solicitor when they are not. Advertising oneself as solicitor or law firm without authorization is serious because the public relies on those titles as markers of regulatory protection.
Other regulators of legal services. The SRA is not the only frontline regulator. The Bar Standards Board regulates barristers. The Council for Licensed Conveyancers regulates specialist conveyances. SILEX regulation oversees chartered legal executives who increasingly can obtain independent practice rights in specific fields such as conveyancing or probate without needing direct solicitor supervision. Their step has eroded the traditional hierarchy where solicitors sat unambiguously at the top of the tree. In addition, the Legal Services Act introduced alternative business structures. These are entities in which non-lawyers can be owners or managers and where legal services may be offered alongside other professional services such as accountancy or financial planning. An ABS still requires authorization and is subject to the same principles and codes of conduct, but it must also appoint a compliance officer for legal practice, COLP, and a compliance officer for finance and administration, COFA, and it must hold an ABS license. The ABS model opens the door to external investment and multidisciplinary practices while preserving regulatory standards.
Combating money laundering. Anti-money laundering and financial crime compliance sit at the intersection of criminal law and regulatory obligations. The legal profession is formally recognized as high risk for money laundering because solicitors handle client money, facilitate property transactions, create companies and trusts, and act as intermediaries in complex cross-border deals. At the heart of the criminal regime is the Proceeds of Crime Act 2002. This statute defines money laundering offences in extremely broad terms. Criminal property covers any property that constitutes or represents, directly or indirectly, a person's benefit from criminal conduct, if the alleged money launderer knows or suspects that it is such a benefit. The predicate conduct can be almost any crime and may have occurred abroad, provided it would also be criminal under UK law. Poker sets out three principal money laundering offences that are especially important for solicitors. The first is the offence under Section 327, often described as concealing. It covers concealing, disguising, converting, transferring or removing criminal property from the jurisdiction. A solicitor here knowingly transfers funds derived from fraud through a client account to another jurisdiction commits this offence. The second is the arrangements offence in Section 328. This is particularly significant for the profession because much transactional work can be characterised as entering into arrangements. The offence applies where a person enters into or becomes concerned in an arrangement which they know or suspect facilitates the acquisition, retention, use or control of criminal property by or on behalf of another person. A solicitor who structures a transaction in a way that they suspect is intended to help the client integrate the proceeds of crime into the legitimate economy risks liability under this section. The third principal offence under Section 329 covers acquiring, using or possessing criminal property. In theory, even receiving fees paid with the proceeds of crime can fall under this section, though there are complex issues about adequate consideration and de minimis thresholds that are beyond the scope of most SQE questions. The mental element for these offences is knowledge or suspicion. Suspicion is a relatively low threshold. It requires that the solicitor thinks there is a possibility, which is more than fanciful, that the property is the proceeds of crime. There is no requirement that they be certain. This low threshold is deliberate because the money laundering regime expects professionals in high-risk sectors to err on the side of caution. Alongside these principal offences, poker imposes obligations on those who work in the regulated sector, solicitors doing transactional work, for example, to make disclosures where they know or suspect money laundering. The failure to disclose offence in Section 330 arises where a person receives information in the court of regulated business, which gives them knowledge or suspicion, or reasonable grounds for knowledge or suspicion, of another's money laundering, and they do not make the required report. This introduces an objective element. A solicitor can be criminally liable even if they did not in fact suspect money laundering, if the reasonable person in their position would have done so based on the same facts.
In practice, this means that ignorance is not a safe defense if the warning signs were obvious. Once a suspicion arises, the solicitor must usually make an internal report to the firm's money laundering reporting officer or nominated officer, who in turn may make a suspicious activity report to the National Crime Agency. If proceeding with a transaction would otherwise involve a money laundering offence, the firm may seek defence against money laundering by requesting consent from the NCA to continue. During this period, the solicitor often has to delay or pause the transaction without being able to tell the client why.
This constraint links to another offence, tipping off under Section 333A. It is an offence to tell the client or a third party that a suspicious activity report has been made or that an investigation is underway, where that disclosure is likely to prejudice the investigation. This can create acute ethical tension. A solicitor may be required to delay completing a purchase or transfer or to refuse to act further, but cannot reveal that the true reason relates to a money laundering report. They must instead give a neutral explanation that does not expose the existence of the SAR. If POCA creates the criminal offences, the Money Laundering Regulations 2017, as amended, create the preventative framework. They require firms to put in place risk-based systems and controls to manage the risk of being used to launder money. Central to this is customer due diligence. Before establishing a business relationship or carrying out certain transactions, a firm must identify the client and verify their identity using reliable independent sources. Where the client is a company or other entity, the firm must identify and verify the beneficial owner, the individuals who ultimately own or control the entity. Modern best practice extends CDD beyond simple identity checking. Firms are expected to understand the purpose and intended nature of the business relationship, the source of funds for the particular transaction, and, where appropriate, the client's broader source of wealth. In higher-risk situations, the regulations require enhanced due diligence. This includes transactions involving politically exposed persons, clients resident in high-risk third countries, or situations where the ownership structures are especially complex with no clear commercial rationale. The list of high-risk jurisdictions is updated periodically. In late 2024 and into 2025, the UK adjusted its list, for example removing South Africa and Burkina Faso, while maintaining or adding others such as Kenya and Bulgaria. For solicitors in practice, this means that they cannot rely on old assumptions. They must check the current list each time they encounter a relevant jurisdiction. The designation of a country as high risk automatically triggers additional checks and scrutiny. The SRA has also identified emerging and now mainstream risks in its AML guidance. Capital flight from high-risk states, misuse of pooled client accounts to disguise beneficial ownership, and sophisticated forms of vendor fraud in property transactions are no longer exotic. They are part of the expected risk landscape. Firms are expected to have documented risk assessments and tailored controls to deal with these issues, not generic policies copied from templates. Overlaying this existing framework is the new corporate offence of failure to prevent fraud under the Economic Crime and Corporate Transparency Act 2023. This offence came into force on 1 September 2025 and marks a major shift in corporate criminal liability for large organisations, including many law firms. It applies to organisations that meet at least 2 out of 3 thresholds relating to employee numbers, turnover and balance sheet totals. Many large firms clearly satisfy these tests. Under the failure to prevent fraud offence, an organisation is automatically guilty if an associated person such as an employee, agent or subsidiary commits a specified fraud offence intending to benefit the organisation or its clients. Crucially, prosecutors do not need to show that senior management knew about or approved the conduct. The only defence available is to show that at the time of the fraud the organisation had reasonable procedures in place to prevent such offences, or that it was reasonable not to have such procedures. As a result, firms have been forced to look beyond AML controls and consider fraud risk in a broader sense. They must assess the risk of internal fraud by staff, frauds facilitated by poor supervision, and external frauds in which the firm might be used as an unwitting channel. Policies, chaining whistle-blowing mechanisms, and monitoring systems all have to be updated, and because the offence has extraterritorial reach, international firms need to consider behaviour in all their offices where there is a UK nexus.
Solicitors and financial services. The regulatory picture becomes even more intricate when one considers financial services law. Clients often turn to solicitors for advice around major financial decisions, mortgages, investments, insurance, settlement structures. However, most aspects of financial services are regulated by the Financial Conduct Authority under the Financial Services and Markets Act 2000. Section 19 of that Act imposes the general prohibition: no one may carry on a regulated activity in relation to a specified investment in the United Kingdom unless authorized or exempt. Breach is a criminal offence and can render agreements unenforceable. Specified investments include things like shares, bonds, units in collective investment schemes, contracts of insurance, and regulated mortgage contracts. Regulated activities include dealing in investments, arranging deals, advising on investments, and managing investments.
At first glance, that would suggest that many everyday activities of solicitors, such as recommending a particular indemnity insurance policy or suggesting that a client should accept shares rather than cash, might require FCA authorization. In practice, most firms rely on the exempt professional firms regime in Part 20 of FSMA. Under Section 377 and related provisions, firms authorized by a designated professional body such as the SRA can carry on certain regulated activities without FCA authorization, provided they meet the conditions of what is commonly called the incidental test. The incidental test requires, in essence, that the financial services activity be probably incidental to the provision of professional legal services, that the firm does not market itself as providing regulated investment services in its own right, and that any commissions or benefits received from third parties are handled in accordance with SRA rules, including clear disclosure and accounting to the client where appropriate. For example, arranging a defective title indemnity insurance policy as part of a conveyancing transaction is incidental. Running a side business selling life insurance policies to anyone who walks in off the street is not. Firms that wish to operate beyond the incidental scope generally need to obtain FCA authorization or to work closely with an authorized intermediary. Insurance distribution has its own additional regulatory layer following the implementation of the Insurance Distribution Directive. Even when relying on the Part 20 exemption, firms involved in arranging or advising on insurance products must appear on the FCA's exempt professional firms register as undertaking insurance distribution. They must appoint someone, sometimes called an insurance distribution officer, to oversee compliance. When arranging products such as after-the-event insurance for litigation, solicitors must assess the client's demands and needs and ensure that the recommended product meets those demands and needs. The SRI Financial Services Scope Rules make it clear that firms may not undertake insurance distribution activities at all unless they have notified the SRA and appear on the relevant register. Development in the financial services world also affect expectations of solicitors around client care. The introduction of the Consumer Duty and FCA regulation, which requires firms to act to deliver good outcomes for retail customers, has influenced how the SRA frames its own rules on information and costs. The SRA codes require solicitors to give clients information in a way they can understand and to make sure clients are genuinely in a position to make informed decisions about services and pricing. This goes beyond merely handing over a long, fine-print client care letter. The obligation is to communicate in a way that works for that particular client, including those who are vulnerable or have low financial literacy, and to ensure that the fees charged represent fair value compared to the benefits delivered.
Funding legal services. The question of how legal services are funded is both a regulatory and a practical issue. Understanding funding mechanisms is essential for SQE because advising on costs and funding options is part of what a competent solicitor is expected to do. The current landscape is a patchwork of private fees, risk-sharing arrangements, and a significantly reduced legal aid system. Conditional fee agreements are one of the key risk-sharing mechanisms in civil litigation. In a typical no-win, no-fee agreement, the solicitor agrees that if the case is lost, the client will not have to pay the solicitor's basic fees, though they may still be liable for disbursements and potentially some of the opponent's costs if those are not otherwise insured. If the case is successful, the client pays the basic costs plus a success fee, which is an agreed uplift. Since the reforms under the Legal Aid Sentencing and Punishment of Offenders Act 2012, success fees are usually not recoverable from the losing party and must be paid out of the client's damages. To prevent exploitation in personal injury cases, the success fee is capped at 25% of the combined total of general damages for pain, suffering, and loss of amenity, and damages for past financial loss. Damages for future losses are protected and cannot be eaten into by the success fee. The cap includes VAT. Solicitors must give clear explanations of the effect of these arrangements so that clients understand that no win, no fee does not mean no cost risk of any kind. Damages-based agreements are an alternative model. Under a DBA, the solicitor's payment is a straightforward percentage of the client's damages, subject to statutory caps of 25% in personal injury, 35% in employment tribunal matters, and 50% in other kinds of civil litigation. Unlike a CFA, the DBA fee is not an uplift on time-costed work, it is the whole fee structure. The DBA regulations 2013 have turned out to be extremely technical and unforgiving. In 2025, the decision in Reeves v. Frayne and McKinnon of the Senior Courts Costs Office underlined this. In that case, solicitors had entered into high-value DBAs in a probate dispute over an estate worth around £100 million. They attempted hybrid structures in which they charged some conventional fees alongside the contingency element. The court held that these models were inconsistent with the regulations and therefore unenforceable. The result was that the solicitors could not recover millions of pounds in fees for years of work undertaken under those arrangements. For a would-be SQE solicitor, the lesson is stark. If a DBA does not comply strictly with the regulations, the firm may not get paid at all. Third-party Third-party funding adds another layer to the funding landscape. In these arrangements, an external commercial funder agrees to cover some of the client's legal costs in return for, typically, a percentage of any damages recovered. If the case fails, the funder loses its investment and may, depending on the terms, cover adverse costs or some of them. A Supreme Court's decision in Pakar in 2023 transformed this market by holding that certain litigation funding agreements were in fact DBAs and therefore unenforceable if they did not comply with the DBA regulations. This caused significant uncertainty. Later legislation has partly addressed the position for collective competition proceedings, but outside that sphere the market remains cautious. Solicitors advising clients on third-party funding must explain not only the headline funding figure, but also the likely percentage deductions from any recovery and the risk that the agreement might prove unenforceable.
The shrinking scope of state-funded assistance through legal aid is another critical feature. Civil legal aid is administered by the Legal Aid Agency and is available only in limited categories of case, principally asylum, certain immigration matters, domestic abuse cases with evidence, public family law proceedings such as care orders, mental health tribunals, and some housing matters involving homelessness or serious disrepair. Even where the type of case is in scope, the client must pass both a merits test and a means test. As of 2025, the financial thresholds are relatively stringent. There are upper limits on gross monthly income, on disposable income, and on capital. Some applicants receiving certain passporting benefits automatically satisfy the income test, but capital may still disqualify them. The government has acknowledged that these thresholds have been eroded by inflation and promised a means test review to update them. However, implementation of the review has been delayed until 2026, leaving the restrictive 2024 and 2025 thresholds in place. For SQE candidates, that means they must work with the current regime, not the promised future one. Criminal legal aid operates differently. At the police station stage, advice and assistance are available free for all detainees and volunteers regardless of means. For representation in the magistrate's court, the defendant must satisfy both an interests of justice test, often framed through the Widgery criteria, which consider factors such as risk of imprisonment, complexity, and ability to self-represent, and a means test. In the Crown Court, legal aid is in principle available where the interest of justice test is met, but applicants with higher incomes may have to pay contributions, and there is an upper threshold beyond which defendants are expected to fund their defence privately. The means assessment is detailed, involving deductions for tax, national insurance, housing costs, childcare, and a fixed cost of living allowance from gross income in order to arrive at a disposable income figure. Another aspect of public protection is professional indemnity insurance. The SRA's indemnity insurance rules require all authorised firms to carry insurance that complies with the minimum terms and conditions. For incorporated firms and LLPs, the minimum level of cover per claim is generally £3 million. For sole practitioners and traditional partnerships, the minimum is typically £2 million. The policy must cover civil liability arising from private legal practice, usually including negligence, breach of trust, and certain other heads of claim. It will not cover criminal fines or most regulatory penalties, but it does often cover defence costs in civil claims and some regulatory investigations. A crucial feature is the requirement for run-off cover. If a firm closes, its last insurer must provide 6 years of cover for claims arising from work done before closure, even though no new premiums are being paid. This ensures that clients who discover negligence years later are not left without a solvent defendant. In conclusion, the regulation of legal services in England and Wales is a web of interconnected obligations and consequences. A failure to carry out adequate money laundering checks is not just a procedural lapse, it may be a criminal offence under the Proceeds of Crime Act, a regulatory breach attracting unlimited fines, and a failure of competence under the Statement of Solicitor Competence. Misunderstanding the damages-based agreements regulations can convert a spectacular courtroom victory into an economic disaster for the firm, as seen in recent case law. Overlooking the boundary between unreserved legal work and reserved activities can lead to criminal liability for unauthorized practice. Blurring the line between legal advice and investment advice can breach the general prohibition under FSMA. For the aspiring solicitor, success in the SQE requires more than memorizing lists of rules. It requires an appreciation of the hierarchy of duties, where the rule of law and the administration of justice sit above client preference and commercial convenience. It calls for the ability to spot the invisible lines, the point at which a paralegal's work amounts to the conduct of litigation, the moment when a casual discussion about insurance becomes a regulated financial services activity, and the telltale signs that a client's apparently smart business deal may actually be an attempt to launder criminal funds. As the profession moves through 2025 and towards 2026, the regulatory grip is tightening, particularly around economic crime and fraud. The new failure to prevent fraud offence and the tougher stance on sanctions compliance highlight that the modern solicitor is expected to function not only as a legal advisor, but also as a risk manager and compliance gatekeeper. Mastering this web of regulation is not simply a way to collect marks in FLK1. It is an essential part of surviving and maintaining integrity in contemporary legal practice.
If you found this video useful, share it with a friend and have a look around the channel for more.